Hello, welcome to the official Singapore market on close. Now, today in the Dubai window, we had kind of a slightly quieter window than yesterday, but more of the same players coming to the fore. So really, we've got Trafi and Totsa driving the buy side. Sell side is really Exxon and Unipec, but also a lot of the other Chinese players like Sinochem and Hengli. And that's a big focus at the moment, given the expected rotation from China to buy more Russian, maybe less Middle Eastern. So them being sell side is an indicative sign of that. The other focus is really on Reliance. Having bought a lot of Middle Eastern, particularly Kazakhstan cargoes recently, they're now apparently selling some of those again. And there is a lot of focus and a lot of scrutiny on what they are doing in Dubai. But in terms of the physical premium, what we had today was pretty much a consolidation. Yesterday, we were assessed at 96 cents. Today, 97. So it's really pretty kind of stationary in that sense in terms of the structure on the physical side. But as I said, we have the two main buyers coming to the fore, being Totsa and Trafi, and the two main sellers being Exxon and Unipec. And so far, what we've seen this month are two convergences, both going to Trafi. Yesterday from Unipec and then today from Exxon. Totsa yet to get a convergence, but they are getting close. So we expect they will get one within the next few windows. And of course, I mentioned that the physical premium hasn't strengthened too much. It's 1 cent higher, so nothing significant. But if you look at the futures market, Dubai and the structure as a whole does seem to have firmed up this morning compared to yesterday when it was extremely weak. So what we have here in the Brent Dubai chart, you can see back over on the left-hand side, around this point here, we have the jump on Aramco OSPs, which saw Brent Dubai rally quite significantly, but that has since fallen off and we're back basically to where we were before. So if you just cut off yesterday, we're at the same place we were, around minus 80 cents on Brent Dubai for M1. And then in terms of Brent itself, we've had a recovery this morning in terms of the flat price. So you can see on the chart here, you've got a bit of a strengthening of the January futures contract, up to around $64 this morning. Had a bit of a wobble going into the window. You can see around this point here, but it's strengthened since, and we are looking at that $64 handle again. So that's quite a sticky area, even if we are going up and down, bobbling along. But 65 looks a little bit out of reach for the moment. More seems that we're in kind of just 64, just sub 64 kind of level. But what is interesting this morning is particularly this rally that we've seen in the prompt spread, because yesterday we saw it go down as low as 20, 21 cents, and that was the weakest we've seen for quite some time. Whereas this morning we've had quite a significant rally. We got up to, if we look to the candle chart, we got up to a high of about 38, 39 cents. Has come off a tiny bit since then, but significantly stronger than yesterday, given we saw yesterday a weakening of the Dubai physical premium, weakening of the Brent futures structure, weakening of dated Brent physical differentials as well. So yesterday, the story was all about weakness. Today, a bit of a consolidation, bit of recovery. And again, that focus really is on the Chinese and Reliance in Dubai. Hello, and welcome to the first episode of the officials from the new Flux studio. We've got a busy week this week, having had some OSPs from ADNOC and Aramco, significant changes to the structure, both in Dubai, dated, and the futures. So we've got a lot to talk through. So let's get started first off with the Aramco OSPs that came out this morning. So guys, what do we think is the key thing to focus on in this OSP release?
Yeah, well, I mean, going into it, the market was pretty split, I think, in what participants were expecting. We saw ranges from $1.60 cut all the way down to no cut for the flagship Arab Light into Asia. And what actually came out, we had a cut of $1.20 for both light and extra light, as well as a cut of $1.40 for medium and heavy. And to me, that's kind of, it's a bit of a middle of the field kind of OSP from Aramco. We saw, according to structures, if you looked at the monthly averages, we're implying a cut of about $1.60. And as we'll discuss, when ADNOC released their OSPs, they were more in line with that. So this is kind of, to me, this is a bit of a firm OSP, actually. It speaks to almost, it sounds like good demand in Asia to me.
In a way, because as you say, we have the full breakdown of the OSPs by grade and by region, so destination region. And as you say, 120 cut for Arab Light and Extra Light, 140 for medium and heavy. And obviously the Dubai structure reduced on average in terms of physical premium by 160 month on month. So cutting it by 120 is, for Arab Light, is 40 cents less than the structure implied. Yeah. The final week average was a bit messy due to the expiry and the various window players going in and out, a bit of a kind of a chaotic final week of the window at the end of October. So I kind of agree with you that it's firmer than I think most were expecting. And in fact, we did a poll on our Twitter account yesterday to ask people in advance of the release what they were expecting. And we had the results here. I mean, the majority, well, there was no majority. It was a minority verdict in favor of $1.01 to $1.50 cut. Yeah. But it was pretty well spread between with the smaller cuts as well, the up to 50 cents and 51 cents to $1.
I mean, just look at that. No change to minus 50 cents was the second most popular. So it was really quite divergent.
Yeah, definitely. But you raise some interesting points here. But I think we also need to flag that the average Dubai parcels price over the previous month's trading was 5 cents lower month on month.
$5,
$5. Sorry. So the change from September trading to October trading average was over $5, and that's pretty cheap. That's pretty cheap. So considering the 120, it's slightly not as strong cut as some would have expected, but given the low oil prices and the fact that everybody's questioning whether we are still in a super glut. And what's the demand from China? Because we also have the story with China. India, we've heard from the market, they're already buying some Upper Zakum, Middle Eastern cargoes. But Russia is the interesting one, because is China going to absorb all of the Russian demand?
The key point that you raised there, I think, was flat price, right? China are flat price buyers. We know that when the price is below 70, price is right, and they tend to come in and buy. There was a lot of concern, I think, in the market that perhaps they've slowed their purchases. We've seen them flip sell side in the window, and also, according to sources, in the over-the-counter markets as well. So, I mean, that was raising a lot of concerns that perhaps the SPR purchases had slowed down. But, I mean, these OSPs into Asia, they're pretty firm. So, I mean, to me, that says, according to the Saudis at least, they're expecting the Chinese to be back buying.
Yeah, and I think obviously the next step in that process is the allocations, which would be pretty interesting, because we had a low month last month. We're down to the high 30 million barrels per day. Sorry, 30 million barrels for the month. That was down from 51 million. So we were coming off quite a high point. And it is seasonally expected, I suppose, for November to be a bit lower due to maintenance and so forth. But that was a big drop month on month. Whether we'll see a bounce back, we've got a bit of a division between the team going on how many we're expecting. We have a little bet going on, but there's no consensus, and that will be a key indicator, I think, for the market as well, because we've seen today there's been a big sell-off as well in terms of both flat price and structure, which seems to be weakening across the board, really.
Yeah, definitely.
Yep, go ahead.
But also interesting in terms of the OSPs, it's that they didn't cut to other destinations. They didn't cut to Northwest Europe, for example. We've seen dated Brent remains very weak for majority of October trading. It was very weak. Physical differentials were negative. We saw a bit of a big steepening. We're going to discuss later in the chart. But as you flagged it as well, it's that seems like kind of a balance they're trying to do right now. But we'll see if there's a bit more firmer demand in Europe. But according to some export data we had seen recently over, I think, the previous month, it was really interesting that we saw exports to Europe were up year on year. So we need to see if that still continues, that trend still continues, and that appetite from Europe.
Yeah, and I think, like you say, the European, both the Northwest Europe and Med, they were held steady to the US Gulf. It was minus 50 cents, so a much smaller cut than it was to Asia. And I think that is largely down to the dated Dubai dynamic. But to move on to the ADNOC OSPs, which we got yesterday, we have that chart up here now as well. And the one to really look at is, I think, Upper Zakum, because you've got Murban is set at, the average of IFAB Murban futures settlement over the month. So that's entirely expected. 443 weaker though, month on month. Like, as it's expected because the settlements in advance. The key thing for the ADNOC numbers are the diffs, and Lulu and Das relatively are much firmer in terms of the monthly delta than Upper Zakum, which got a big cut, 70 cents versus Murban. So we're now down at a $1 discount to Murban for Upper Zakum cargoes.
So on a Dubai basis, that's down $1.70. So that's a pretty big cut, and I think there's a number of different things going on here. We know that our race is running less Upper Zakum. According to Petrologistics, they didn't take any Upper Zakum for our race in October, the first time since 2023. We also know that there's potentially going to be some refinery outage there as well. So we've got more exports, and therefore it makes sense then needing to create that room in the market.
Yeah, I think the refining side is also important as well, because as you mentioned, our race obviously not taking as much or any Upper Zakum. That's kind of been a trend since early summer when we had the whole situation with the Murban export schedule being changed, last minute impact on the cargoes being reduced and then increased again to the full amount. So that's one of the key factors. Also, we have refinery outages in India, unplanned, Kuwait as well. So we've seen a massive rally in gas oil cracks, and we haven't seen the consequential rally in medium sour Upper Zakum, which yields a lot of diesel, a lot of fuel oil. And I think that's been really confusing a lot of people.
Definitely.
And I think partly it comes down to the fact that maybe there just isn't enough capacity to absorb it, given these outages.
Isn't there, and all of a sudden you have an excess of cargoes. It'll be interesting to see how long that lasts, how quickly they can get refinery capacity back online. But we have turnarounds in Europe as well. So, I mean, it makes sense that the market is fundamentally quite long right now.
Yeah. And in terms of Upper Zakum, again, in the window, so the spot window, we had a lot of convergences last month that were Upper Zakum. So, Spiros, do you know exactly like why, what that could tell you?
Yeah, definitely. I mean, it tells us that Upper Zakum is basically the cheapest grade, the most competitive grade in the window. Well, the last 2 months pretty much were very interesting. We saw in September trading, Upper Zakum was declared so many times that it was on a barrel per day basis. It was over 630,000 barrels per day. So that's about, if we were to, according to some of our sources, that's 50-60% of the Upper Zakum field production daily.
Yeah.
So it means, the demand was there, and Upper Zakum was the cheapest one, and it continues to be cheaper relative to Dubai. If we're going to see, if we're looking at the diff here, that's about minus 5.1. Dubai was around minus $5. So, 10 cents cheaper than Dubai. It seems, that's still going to be the cheaper grade along the way.
Yeah, and I think it's even worth noting that it weakened relatively again in October even further. Like we had a 10-cent discount looking at the average of the Dubai partials assessment versus the ADNOC OSP for Upper Zakum for November, and then for December it's a 20-cent discount to Dubai. So it is weakening even further. But talking about weakening, we had as you mentioned, Spiros, a very weak period in the physical differential for dated Brent in October. It recovered significantly last week, but it looks like things are going the other way, and it's kind of gathering steam in terms of this overall structural decline. So what do we think is going on here?
I mean, recently you never know what's happening in the dated. We had so many quiet days in the window, and then we had a big rally. I remember at the start of October, Vitol came and they were started bidding a lot. That shifted our physical differential up to almost $1. That was a dramatic move. And then, it was another week of pretty much no activity, and people started offering. And then recently, over the last few days, the same trend happened again. So we need to see what's going on in the physical demand, at least in North Sea. CFDs are very weak right now. However, from memory, including the BAL week, we also have week 1, week 2, week 3. They're all deep negative right now. So that means that prompt demand, expected demand over the next few weeks is gonna be decreasing. So it's interesting where we're gonna see where we're gonna see this to play.
Yeah, I think part of it does come down to the refinery situation again. Like, autumn tends to be this maintenance period, same as it is in China, where we saw the reduced allocations for November as a result of that. But the North Sea has been very choppy lately. Like you say, you had the period where it was a lot of bidding coming in, very little sell side interest, and a quiet period, the opposite, and then another quiet period, and then lots of bidding, no real sell side interest, and then it's completely flipped. The last couple of days, we've had loads of offers, very, very aggressively lowered, and nobody's coming in to lift them. So really, I think it's partly a window thing that it's being so choppy, partly due to the function of the window.
What do you see dated going from now, guys? I think, freight is very expensive right now, especially Midland. It's very, very expensive. So I wouldn't be surprised if we go again negative in the next few days.
Yeah, I think you need someone like a VTOL or a big player like that to step in and start lifting the cargoes, maybe begin bidding. But then there is the threat that we flush out a few cargoes, and then we have a buy side play that comes in and raises it even more. We have another aggressive move upwards. So that's a tricky one to call, I think.
Yeah, no, and soft in the North Sea.
Yeah, and then that softness also extends to the futures spread. So here we have the January, February Brent futures spread, and like since the sanctions, where you can see at the beginning of the chart there, end of October, you had that massive jump in terms of the spread when everyone was beginning to talk about contango threat. Like there were only a couple of spreads that were still backdated, had that jump on the EU and US sanction on Russia. And then since then, we've been kind of steadily declining, particularly through November. And today, even since we took the screenshot, we've weakened further down to like 22 cents on the prompt spread. So, we are looking at a much weaker futures curve, and this is, I think, reflective of the weakness that we're seeing in the physical as well, in terms of both Dubai and dated Brent physical differentials and premiums both coming off. Is contango coming? Full-on contango, guys?
I mean, March and April right now, the futures are trading in parity. So we're zero there, and then April onwards, everything is in contango again. So it seems this super glad stock is, although we're not hearing about it, people are for some reason worried. Everybody is also questioning how much crude is stored in the sea that's floating and not being transit. Although this number is falling week on week according to some ship trackers. It's still on an elevated number, but I don't see that this weakness that much that would cause something like the prompt spread trading around 20-25 cents.
I think there's a range of factors again going on here. I think yes, demand is probably a little bit soft relative to supply, especially now that we've had Saudi producing a bit more than they were before, although the recent OSP setting seems to suggest they're probably not going to be bringing huge amounts online. So yeah, fundamentally, it looks like balances are probably a little bit long, but we've got refinery outage, so naturally that's going to soften crude spreads. But we also have very low product inventories, which is leading to pretty tasty margins for a lot of refiners. Like if you look at Onyx indicative refining margins in Asia and Europe, they're the highest they've been all year. And that naturally at some point will incentivize capacity coming online. We know in China, for example, there is a lot of spare capacity that can be tapped, and they've definitely been buying enough crude for it. So that's one area that could come back online and resurrect a little bit of strength in the physical crude market. It's very hard to gauge at the moment what demand is looking like, I think. Demand, one, we're starved of data from the US with the longest shutdown that's ever happened
in history,
but two, also those kind of key regions like China, it's very difficult to tell. We're seeing a lot of diverging signals on the macro side.
But when it comes to the product stocks as well, you mentioned they're low. And I think it's worth mentioning as well that in the US, particularly distillate stocks, given the EIA data yesterday, I added them up, and since kind of mid-late September, they've drawn more than 13 million barrels from distillate stocks. And gasoline stocks keep falling as well. We had a big build in crude, but that followed a big draw last week. So the crude seems to be going up and down a bit. It's a bit wobbly. That, I think, largely depends on the imports. So last week, for instance, we had a big drop in imports, consequential big drop in inventories. But the products do seem to be going one way only, and that is down, both for gasoline and distillates.
And of course, time spread structure is a function of supply, demand, and inventories. And if we're drawing on products and products are low, then for me, it's going to be tough to drift into a futures curve contango for an extended period of
particularly with such strong margins. I mean, December EBOB margins are incredibly strong, and unseasonally so. So,
I mean, and we know turnarounds are happening at the moment. They should unwind within the next quarter, and then come first quarter of next year, I think we'll be trading in a much healthier looking.
Yeah, definitely.
Okay.
Especially the distillates, the middle of the barrel. Gas oil roofed this morning over $32 per barrel, and it's really interesting to also flag Russia is a big exporter of diesel, and they put this export ban in September from memory only to refineries that are not producers as well.
So for example, Rosneft can operate a refinery and export its diesel. But an independent can't buy oil, process it, and then export diesel. It would have to be an integrated major.
But I saw some interesting data in October, for example. Russia, also the Kuwait refinery played a big role. The exports from diesel exports are very down on seasonal levels, but also on the year. We're talking something from memory, I think around 10% lower. So gas oil stocks are significantly low everywhere, all over the world. So that needs to come back up at some point, and that implies obviously some medium sour or heavier crude strength that we could see onwards. Especially, in my opinion, in Dubai, we had the physical premium around 96 cents this morning. That's pretty weak.
That's weak. That's the weakest we've seen for a while. Really. So I think frankly there is a case to be made for this being the kind of the bottoming out of the crude structure, and that we're going to see a bit more backwardation. But that's one to see, really, I think, with the refining situation and with the inventories situation, particularly for products. So anything else that you think we need to touch on, guys, or is that basically a good rundown of the last week or two in the markets?
That's pretty good from my side.
Okay. Well, very good then. Thank you for watching, and see you next episode of The Officials.
Hi everyone, I'm joined with Vincent from Flux Insights. We're going to discuss the major themes in crude this year, 2025, and some of the things maybe going forward. This is about the narratives, the themes, the positioning, some of the more nuances and Brent Dubai, dated Brent and all the rest of it, and just give a general overview, right? So Vincent, take it away.
For sure, let's get started. So talking about the key crude themes this year, you can't go without talking about the overarching narrative, which is OPEC unwinding their voluntary cuts.
Absolutely.
Which that has, the first tranche has been completed in September, and they're beginning their next tranche, the 9-member voluntary cut and the collective group cut that's supposedly ending by the end of 2026. Of course, that is quite, the market has a bearish interpretation. Whether that's actually bearish for the physical, that's very much up
That's
for
what's
debate.
been up in the air. So I think, coming into this year, they were actively unwinding on paper. They were calling for it. We're working through this kind of volume triangle, whatever you want to call it. We're about here, right? We're starting to get towards the end of this in theory, right? And we're starting to get to the last 2 million. But really, like as Jorge has been going on about, the officials have been going on about, the data is so spurious. The ideas, the talk of the super glut has been, just banded everywhere. Every trade house, every consultancy is looking at their supply and demand balances and saying, on this, in theory, data, this is what the result is, but we just haven't seen any evidence of that in the physical market. In the benchmark pricing. But then we're into that dichotomy of like how are benchmark contracts priced? They're priced by freely available oil and or traded oil, and of course sanctioned oil can build and be oversupplied, but not filter its way into the price. So that would be like, just to like lay it like straight away. This will drive hedge fund narratives. This will drive kind of tourist narratives. The market should come off because OPEC is supplying more. But really, I mean, just immediately from a crude trader myself, it's like, okay, I'm only ever going to position, if I really believe in this, and I really believe there's a lot more supply to come back, I'm only ever going to look at Brent Dubai as a proxy for, is it really happening? Brent Dubai has been negative for majority of the year, certainly weak for the majority of the year, and actually went shockingly low, like -3, -4 levels in the prompt, after they announced the latest cuts. So it really doesn't really add up. But yeah, anything to add on that generically or about the narrative?
No, in terms of the physical market, we haven't really seen that weakness, as you mentioned. And
Well, the physical market, oil and water, like we could get into that, but it's more the physical pricing of the benchmarks. We haven't really seen it.
And for the Saudis, they have a bit of spare capacity, but other producers, they were overproducing initially, so maybe they are maxed out in terms of their production, as well as Saudi, they're sacrificing their revenues for market share. So that's another big theme as well.
Do you think there's enough information out there, Financial Times, Bloomberg, etc., more generic, bigger media, have they reported enough on the fact that this data seems spurious that could filter into more of the touristy hedge fund narrative?
To be fair, Reuters did come out with a headline mentioning that only 75% of the supply hikes have been actually completed out of the stated amount. So a lot of the hikes is just notional, just the numbers only. Hasn't really. Not many countries can actually have the capacity to raise that output. So it's actually more bullish than stated.
Sure. But as you said, that's been the leading theme. Hedge funds have been shorting all year. CTAs have obviously been going with it. We've got max short there. I'm sure you'll go into all this. And it has worked, largely speaking, right? We got down to almost, I think it was 60.07 on the very low of Brent. Yes. You've got the price, nice.
So this was in early April, and another big catalyst was the Trump's Liberation Day announcements, which also catalyzed a big sell-off too. So confirming prices down into the $60 range.
So going into, this is April. God, it's crazy to think back now it was at that level. But this is the Liberation Day tariffs and the carnage on that day. I know the market was positioned generally bearish as a kind of sentiment, as a kind of a discretionary trade, CTAs, and people holding puts. I think there was quite a lot of interest in holding some of the options, trying to see this like move down throughout the rest of the year. You got really paid aggressively on this move if you were owning puts in particular, because volatility absolutely split out. It's such a big move. Volatility roofed, and the price obviously moved down quite aggressively. So these kind of 60 puts did very well for a time. But what was immediately obvious there when the sell-off happened was when you compare it to other years, other years you're getting negative refinery margins, negative crude differentials, negative time spreads, and it's kind of flat price has to go because it's just a house of cards. It was kind of the complete reverse. Flat price did move, generated by a big like macro sell-off. The weight of the risk-off money in the hedge fund world and all that really kind of drove this down, it seems. But once we got towards the low 60s, the front Brent spreads just wouldn't move. And it was about 30, 35 cents from memory. And it was there. And it made you think, God, flat price moving like almost $10 and it doesn't want to budge. That is like the North Sea traders are really looking to own that time spread, which means they're really confident in the physical and holding the physical. So actually that became a buy. And then when we leveled out, that time spread went all the way back up to $1 positive. And if you're $1 positive on a time spread, that's just, you can't say anything other than that's a strong market. But that's my anecdotal thing there. Anything to add on the general theme being, bearish throughout the year because of OPEC? But is that really why it went down? I mean, who cares for a trader? But is in like all the signals whilst it went down kind of didn't really signal that we're actually oversupplied.
No, it felt like actually previously it was when Brent was trading between 70 and 80, it was always quite tentative, always felt like something was wanting to pressure prices down. And now then OPEC coming out, Trump's liberation day, the cat was out of the bag, gave the macro market really a reason to accept the lower prices when other players most of the market wants to be bullish. They finally accepted this lower narrative. But of course in the physical market wasn't so, didn't really indicate an oversupplied market. So it's more of a reset. Basically. Yeah.
Okay. So you'd be forgiven for retail traders, investors, people who aren't, oil professionals, would just look at that and say, OPEC are producing more, oil prices down is completely logical. But I think our initial review of this is like, it's very much a positioning thing. I'm not really sure it was about anything other than that because nothing followed through on the physical signals. But why don't we go to the next thing?
The next part, another key thing driving the markets, that was in June, the 12-day war between Israel and Iran.
Of course.
Which those attacks saw Brent spike into the 70s, even up to the high 70s for a few days until Trump came out, until a ceasefire was announced between the two countries, which this was a moment where volatility had really spiked. There were a lot of call options being put on, but as has been a theme over the past couple of years, the market really usually intends to sell into these rallies and geopolitical risk when, as soon as it comes out that, as they realize that the disruptions to exports or supply or infrastructure wouldn't be affected, that there wouldn't be a regional spillover in the war. So that's the main key theme. So market really sells into these rallies.
Yeah, there's a time decay to these things. There's high tensions and all the threat, but the tension can remain high geopolitically, but every day that real oil isn't being disrupted is a day further the market is starting to calling bullshit basically. And so you have a kind of natural time decay in moves like this. And then you also have a natural time decay in the options that you're owning. That is real value deterioration. But we were very vocal about this. Like you just said, we had the move down to low 60s. The market was comfortable with that because it aligned up with the OPEC narrative. It was seen as the tightness in the front, I guess, was going to be fleeting. You had consultants and banks, etc., talking about their supply and demand models, indicating oversupply, just not yet filtering into the benchmark pricing. So that's when this started to filter. This is when we started to get that narrative slightly shifting. The kind of feeling of, okay, I know you haven't seen it yet, but you will. And then it was like in Q4 is when you'll see the builds. That's when this narrative started to happen. So you still had quite a bit of short positioning here. So in this rally from 65-ish up to the peak, just below 80, because the market wanted to be short, let's say, from a discretionary basis, we said it was massively an options rally, wasn't it? It was a very local to call options is where the majority of the market put that trade on, which if you think about it, made a hell of a lot of sense because options are all about insurance, right? So you're insuring against a huge price spike, but you're positioning for it to go down. So you don't think this is going to last, but you don't know. And when people start talking about closing the Straits of Hormuz, well, that's actually a new thing, as in we've talked about it a million times, but the Iran are actually threatening to do it. You've got Polymarket saying, will they close the straits? And people are betting on it. And there's people in the straits themselves from ships talking about it. It was genuinely a threat. So if you don't believe that oil prices should be high, but of course you recognize some huge event could be likely and cause price spikes, you're going to buy insurance. So it was a massive scramble to buy call options. It was a massive volatility rally. But when it got to its peak, which was kind of like the Sunday night really, and you had weekend trading on IG and you had people like really thinking it was going to go on from here. As you said, that's when the market says, do you know what? They didn't close the straits. They talked about it in government and they said they wanted to close it, but nothing really happened. I think this has reached its peak. I think it's fever pitch. And this is when we got this really aggressive sell-off, which was really a sell-off in volatility if you were looking at the volatility on the options. And then of course the direct price, and that was kind of the end of that, right?
Sure. So it just ended very, very abruptly as well. That was when Iran struck one of the US airbase, US military bases in Qatar, and the market treated that as the ending of the war, because as in they allowed Iran to do that to escalate to de-escalate, and then afterwards Trump came out saying that both countries had reached a ceasefire, or he forced a ceasefire on them after the next day actually swearing on TV as well, which made both sides get the point. So then abruptly Brent returned to really normal, and then the market just returned to its old narratives.
You're a fan of Trump and his narratives. You always have been. You always comment on it, make jokes, all that kind of stuff. The point is that the new age thinking, particularly for a younger guy like yourself, is to be very in tune with the temperature of the dialogue. But if you go back, say, 10, 20 years, you're getting official narratives from governments, and you are really, genuinely believing in what the policy statements are and the conditioned narratives. And it's very, I don't know, in retrospect, very organized. These days, people are tweeting like Trump. There's all these threats from Iran. They're sending videos at night being with like pictures of bombs, being like, this is it now. My question to you would be, on retrospect, where is the predictability in the chaos? Because like you said, it kind of was, right? Like you're saying, swear on TV, you get these kind of indications and you go, see that, I think that's de-escalation. You're getting a lot of transparency and live visibility into the thinking of these people. Do you see what I'm asking?
Yeah, exactly. Similar to the attack on the airbase as well. It's very similar to last year. There was the Israel and Iran also traded attacks to when Iran returned retaliated against Israel. That was very, very telegraphed. Talked about with intelligence and military, like the US military in advance. So that was when the market interprets this as kind of like a performance. Then it means that both sides have been given an off ramp, and this was the case in the Israel and around 12-day war as well. So
is the answer, because when I say where is the predictability in what's seeming chaos?
Yes.
Is it to recognize that it's a drama?
To recognize this, yes. Well, the official narrative would be to recognize that there wouldn't be any disruption to...
recognize that they're all playing games. And if you're comfortable with that, you can start to look for the signals. Whereas someone more, let's say, old school or kind of not, or a bit blind to the game and the agendas, they find it harder, right? They're like, hang on, this is chaos. Like,
yeah, so kind of reading between the lines in that sense.
Yeah. But it's funny because I think particularly the newer generations are finding it very comfortable, in fact, very relatable to see people like Trump, people like even the Iranian generals and these people, the propaganda, they're actually very comfortable with it because it's immediate feedback, and you can kind of weigh up the feedback and people's comments, and the interconnectivity we have around the world it's actually incredible. In an event like that, you've got people on the ground saying, yeah, look, we're trying to get out of Iran right now. I'm blocked up. I'm trying to get my, I've got staff saying, I've got to leave because I've got to try and get my mum to the border and things like that. And you've got information that way, like live. You've then got obviously Twitter, people tweeting like all the time, threatening, we're going to bomb tonight. And then like all this kind of stuff. It's incredible how transparent everything is and playing out in front of you, that someone like me or you, just literally sitting in London, like watching from a phone, can get a very like good sense of what's actually going on, and then we can judge it. You see me? I think your generation is very comfortable with that.
Oh, for sure. They also call OSINT, open source intelligence. So, and especially, for example, the Russia-Ukraine war, just to go on a tangent, there's a lot of military footage, and then often these military analysts online, they can interpret these videos from these various Telegram channels and judge based on like how much progress each side is making. So with this is you just really using the power of the internet and like geolocating things and using that to your advantage. And
so again, if we go back retrospectively to this event, I would say with AI, it's not like it wasn't here this year. So you can't say in the future it might be difficult in these scenarios. It's happening right now. Just to add on to your thing, someone might say, okay, well, if you've got all that open source intelligence, that makes you very vulnerable to a very well done AI video to cause a price spike and all that. We actually haven't seen that, have we? We've seen people take every video and go, I don't know about that. And it's actually quite hard to convince people that something's real until they see the hard evidence. That's quite interesting, isn't it? Like, for example, the Qatar thing you just said. We were getting live streamed. It was in those the Qatar bums. People were sitting in their balconies in Dubai and going, yeah, we're watching. And it's like people need to see that, don't they? Because of AI, because of recognizing that you can manipulate videos. Is that a fair point?
Yeah, for sure. It's especially with the advent of AI, so many deep fakes can be created, not just of events happening, but also of famous people speaking as well. You really need to verify that. For example, when Trump said at the F-bomb, they were coming out saying that was not AI. He actually said that.
Yeah.
So it's very interesting about like verifying information. If people react to supposedly fake news, then that really has an outsized impact on really people's positions, P&Ls.
But I think you said it quite well. The industry or the professionals are looking for this. They love this false peak. They really, I mean, we know one particular trade house, but I'm sure a few trade houses were actually short volatility, did very badly on the way up, doubled down here and then made it all back, which is kind of as you'd expect these guys to do. They get caught out fine, but they recognize what's going on. They stay calm and they're ready to sell off when it happens. So this is where you're getting the dangerous area. If you've obviously maybe just a natural long position and you catch a spike or you kind of buying into this, fine. But when you're coming into, a few days of the crisis and you got people like Andrew Tate saying, I'm buying 1 million barrels of oil because of the crisis, that was more last year actually. But like, that's when you're like, ooh, we're looking peaky here. If Tate's getting long, if people like that getting long,
exactly.
You're like, it's too in the narrative and not enough has happened for us to believe it can go any further. You're right. That's when the industry's starting to think, okay, what's overpriced here? Because that will be a good risk reward trade. It's scary, but nonetheless. Okay. Let's move on from that then.
So onto a bit of positioning as we've touched on a bit earlier. So onto our Flux Insight CTA model. This is for Brent futures. We've been seeing that recently, particularly recently, CTAs have been close to their max short level. So we can see the rises and falls sort of in line with the price action. So during the 12-day war, there was a brief increase and then positions slowly coming off. But what I wanted to touch on is that recently, as there's been more and more talks of the oil glut narrative, Brent potentially collapsing below 60. There's also a bit of technical analysis on that, but we've been seeing the CTAs were close to being max short. So what this means is there's not that much capacity for them to add new short positions.
It also creates a vulnerable market for spikes every time.
Which is what we saw recently in the last couple of days. So.
Exactly. So absolutely bang on. I mean, that's what I would emphasize too. But I think I would just say the theme of 2025 has been a saturation of this information. 2024, this was hot information. This was, everyone wants their data. Everyone kind of wants, from Bridgerton or Flux or whatever to be like, where are people actually going to sell this stuff? Sorry, where are the CTAs going to get their sell signals or buy signals? Because it's all relatively transparent. That's why we have these models. There's pre-programmed, momentum signals and data that they trade off. That's the whole point. It's transparent and methodical, so you know what you're kind of trading into, and it's just strict rules. But the point is that whilst that might have been interesting and people trade around it last year, this year everyone seems to have it, right? And everyone is thinking the same way. And this is where it can get a bit dangerous. When there's positioning information out there or when things are too transparent, you're going, well, that's at a maximum low or that's at maximum high. Okay, take the other side or I'm going to avoid hedging because of this, because of that. And it's like, it really can impact market dynamics. Because if I want to go and you want to go and we both stand off, the market can't really function as it's meant to function. A massive like tangent to that, but the same theme, is shale oil hedging in 2022 and end of 2021. There was a great article from the FT, and one of the shale oil producers was saying, I'm not going to hedge. Every single bank is out there saying oil is going to go to 150. Why the hell would I sell side hedge? And you're thinking, yeah, we're bullish too, or whatever. But no, that's terrible news, because if he doesn't sell, there's no liquidity for the market to orderly go up. So what's happening? That natural huge sell side volume we were getting before is now no longer there. So now everyone's just waiting for a price spike. And then when the price spike happens, people are scrambling to take advantage, or when it comes back off, people are scrambling to get the things off. So I would say that's starting to happen. And it kind of happens with any new information, like Genscape, when it first came out way before your time. Genscape preempts the EIAs, right? So the stocks. And so everyone's trading off it, making a load of money. But then everyone wants that information. Everyone gets that information. It's leaked out there. Then everyone's trading off that. And you've just changed the trading paradigm. It basically gets absorbed in. I would say 2025 is the year where this has not become obsolete, but everyone knows it. So don't think it's not priced in or not in people's thinking or whatever else. That would be my take.
Yeah, for sure. The democratization of information, right? When everyone is aware of this, then you kind of need to see new strategies, or to kind of think to when this previously had people thinking 2 steps ahead. Now you need to think 3 steps ahead of what's happening.
That's efficiency. Okay, so let's move to the next one.
Right, just a brief rundown on the technical analysis side of things. So as we can see, this is the chart for Brent futures over the past year, and there's been a lot of support at the $60 level, as we talked about extensively. Very psychological.
Very strong floor, right?
Very strong floor. Yeah. Previously, that was the $70 floor last year, but now that's acted as resistance. But last few days, there's been a lot of narratives about the oil glut, potentially prices falling under 60 when a shale gonna be.
And again, the new theme, new narrative. But again, technically, you had that very, very strong support psychologically and technically, I guess. And the blue line is the 200-day moving average?
50. That's a 50-day moving average. And incidentally, that's where we've seen prices sort of see resistance over the past day. So what this means is that a lot of people, and at a time when narratives are driving the market, when there's a lot of algos, when there's a lot of volatility, people tend to look into the fundamentals the technicals for their day-to-day trading, and these in the market as liquid as Brent futures, these moving averages, the psychological levels really play a huge role in where people buy and sell. And so looking at the moving averages, it's potentially gives a signal onto where prices might see resistance in this case, or in other cases, the prices go down where they might find support. So this is just a snapshot of the latest take on where prices are going right now. But of course, overall,
we're very much at that moving average support line. I think that's incredibly important. And again, if it goes too far, we're going, what market regime are we in here? We've just flipped from a really weakening market, an acceptance that the glut is here because of the oil and water being the highest ever or close to the highest ever. The benchmarks are actually starting to feed that in. It's getting weaker and weaker in dated Brent. We've gone negative in the differentials to literally overnight, bosh. Okay. Now we had a bit of a short covering rally in dated Brent. We had, that actually seems like that was nothing to do with the sanctions. And then the sanctions came in. We've just flipped to a 2022, beginnings of a 2022 narrative, which is insane to think about, how you can go from almost max bearish to max bullish. And it's real, and I guess we're in that scenario where, that's why I brought up earlier, the market, I think, is aware, the wider market is aware that there is this dichotomy of freely available traded oil, and that being a market, and physical oil that's sanctioned, that's on water. The market's had to contend with that forever. I mean, the Iranian sanctions have been around for a long, long, long time. And that was always the case. You have these oil and water tankers that are just there. They're just constantly there. And it doesn't mean it weakens oil prices, because they can't affect benchmark prices. So this is like Iran on steroids, right? So I think people are aware of it and they genuinely believe in this. It's psychologically very, very hard to make money here, because if you're directionally trading and you've got into this narrative, people love to say traders shouldn't be emotional and they should be clear thinkers. It's complete and utter shit, right? The humans aren't like that. And also, it's just not true. When they form stories, they form narratives, that they are obviously going to get invested. So if you're so invested and then suddenly news comes out, you've got a hell of a lot of processing to go through to accept that you're in a genuine bullish market and then go, I'll first of all stop out, which is a hard thing to do for a lot of people, and I'm going to get long. You can flip long short if it's short term, but when you've been investing for a whole year in a short position and you've almost got to the break and you've maybe started this huge bear run, 30, 40 cents of Brent spread to suddenly be highly backwardated, I don't think a lot of people made money there. I think the people who were already long in the North Sea, okay, they've done fantastically well, but that's more luck than anything else or insider information. But for the general market, I think this hasn't been a good thing. Now that we've got this like nice support line here, maybe it's a sign that we could steady for a bit. The market could kind of take a breath. And if this is real, or people are starting to believe this is long-term real, then maybe they can start investing here and there could be some decent money. But we know, obviously. Anything else in technical?
I think the most useful thing is psychological levels and the moving averages. Especially if prices diverge too far away from these average lines, then there's bigger potential for a mean reversion. But in the sense that in the very short term, it's a good guideline for price action or for day-to-day trading in terms of informing when to enter or like position sizing, as well as when to stop out. Because if you want to, a lot of people probably may have placed stops just below 60, but we saw there was clear support at this level, and towards the moving average, we might expect prices to stabilize a bit more. So in a time when the markets are so volatile, chaotic, Trump can come in saying anything, reversing sentiment. Technicals are sort of a little a haven of sorts. Not that it's predictive of price action, but really helps with informing or providing a framework for risk management.
I agree. It's been quite effective because even if you look at this market, CTAs have been short all year. Well, they must have done okay. I'm sure it was very hard here because they were max short around here and then they had to cover. But, they're relatively slow to cover and then they were getting short again. And you have generally performed. It'd be amazing if CTAs haven't net done okay in oil this year. And from technical traders, they've probably done okay because if you're absolutely agnostic to the physical, you're not getting blindsided by the physical narrative, the gluts. You go, look, it's trending down. There's some quite nice patterns going on here. And I think it's generally been quite useful. It's traded quite faithfully to some of the core principles here. So yeah, all right, let's do the next one.
Next one, we move on to Brent Dubai. So touched on this a bit earlier. This is on an M1 basis, just quite volatile, but it's reached all-time lows.
Incredibly volatile. This is just for your sake. I've been trading Brent Dubai for a long time, right? 13 years, and the range is typically 50 cents being very much the low, really, to plus $4 being the generic kind of high. That's been a very solid range, and it's never really going through that range. It's either in a regime of low Brent Dubai or high Brent Dubai, and then you kind of have a regime shift, which takes a while to reprice, and then you stay there for a while. This has been, these ranges, you're talking about going from $2.50 to $1. So imagine that was 1 to 4. That's a considerable regime shift. But you're doing that from a negative to a small positive. This is like unheard of, right? So it was undeniably volatile, very difficult for the market. And I think the tourist trade, unfortunately for me, because I was always talking in the bull game on this differential, OPEC supply hikes, it was very low. Actually, we can go back here. And then you should expect a long-term rally as the market reprices because OPEC are back. It's pretty generic narrative, but it obviously should hold. What happened? It tubed and it tubed again. And you say, this is the announcement, right? OPEC announced, and then it tubed again. What's happening here? Well, you can say fundamental narratives, you can say physical narratives, and people love to do that. At the end of the day, this unfortunately is what makes trading the prompt very, very difficult, because if you'd held the back end this entire time, it's kind of been exactly what I'm saying, low positive and just kind of stayed there. I think we're max high 1 on the Cal 26 down to minus 20 now roughly. That's not too bad. That's kind of what you'd expect. In the prompt, you have to stay away a lot of the time unless you're going to be very, very careful on your position sizing, because literally anything can happen. And the narrative was Chinese SPR buying. We've got all the Chinese buying SPRs. Look, it turns out that was bullshit, right? Of course they're buying the SPR, but they always buy for their SPR. It was a pocket of concentrated buying that trade houses were able to use as an excuse to run all the tourists out of the market. All these massive longs that I think people were building up on this generic OPEC narrative. Bang, like let's just clear them all out, get them to all stop out, and then into the pricing month, just take everyone unawares. To get to -$2, it makes no sense, right? There's no justification. This is all about pricing dynamics and the trade house games. And look, what can you say? That's what they can do. That's how the Platts have set up that benchmark. You have to stay out of it. Easier said than done, and I didn't in some scenarios. But I think that at the end of the day, that's the only real message here. If you expect rationality, it's not going to happen. But just to finish off my ramble, I still think this proxy, this Brent Dubai differential, you can get it on Flux. Even if you're listening to this and you're a retail trader, you can still get Flux for free if you have an account and you're trading with us. Even if you aren't going to trade this differential, you should watch it like a hawk. Because if your leading narrative was OPEC this year, then I'm telling you, you can't short flat price or you can't get mega bearish until Brent Dubai really rallies. Why? Because if OPEC is overproducing, Brent Dubai has to rally because the Dubai has to reflect the weakness. Well, it has to be stronger than fucking negative because that is suggesting quite clearly a very tight Dubai market. So if OPEC are going to bring back all this oil, you have to see that Brent Dubai correct for there to be even the suggestion that there could be oversupply in the physical market and sustainably so into the pricing. If not, and actually that kind of proved right. I was very surprised we were selling off as much as we were when the Brent Dubai wouldn't rally. So it's all been a bit random, and that's kind of like, I'm glad you brought up this chart because it's kind of signifies best the year of trading crude. Why is Brent sold off when you haven't really got any logical moves off the back of it on something like Brent Dubai? The CTAs have all been max short, and the physical traders are probably thinking this doesn't make any sense because the market's really tight. I should buy. It's been chaotic. It's not been aligned. It's not been clear. Like in 2014, we had a Brent Dubai rally. We had the physical diff sell off. We had the time spreads go negative. We had all this happen and Brent selling off. It was a very orderly rally on retrospect. It's been nothing like that this year. It's been inverted.
Yeah, very, very much so. It just goes against the logic that you would usually expect.
Basically, yeah. That's what I'm saying.
And to refer to what you were saying earlier about the Brent Dubai previously trading very high, this seasonal chart from Flux really illustrates that. So the white is from 2025, and since last year, really, prices have been...
This is only for the last 4 or 5 years, but even so, it's still the case, right? Like 2022, which is the real, obviously, ridiculous moves we had. Look, it's so high, and that's with Russia being taken out of the game, right? How are we this negative? How do you create a fundamental justification for Brent Dubai being this negative? The answer is just positioning, just not to repeat myself, but yeah, that's it.
I mean, yeah, people do find fundamental reasons, but overall it is just the buy market has been super tight. Although the last couple of days we did the increased sanctions on Russia, where you would
this is actually a bit more of a logical sell-off. I agree. Is that what you were going to say?
Yes.
Yeah. So this one we kind of gapped down, didn't we, in the prompt? It made sense because, again, back to this freely available oil versus sanctioned oil. So the freely available oil, if you want to trade the Eastern, you buy, Al Shaheen, you buy Murban, you buy the local grades in the Middle East or the Saudi crude. Now, the Indians in particular were buying all this Russian oil. Now the secondary sanctions have come in that they can't even buy, or they don't want to buy that oil anymore. They have to go and buy Al Shaheen or something like that. And Al Shaheen directly prices Dubai benchmark. So that had to create a bullish impact, and Brent Dubai had to sell off, fundamentally made sense to. And I don't think people were going to stay in the way of it this time. So I think there were stop outs here. And I think there was also a lot of belief that you can't stand in the way of that. So I agree with you. And maybe now it can become a bit more logical now, who knows?
Yeah, sure. So yeah, that's just whole the Brent Dubai in a nutshell. So against a bit of logic, but recently, as I said, Russia sanctions, more tightness here.
Yeah.
So that's Brent Dubai. Lastly, we'll have a look at the North Sea crude market. So this is just a snapshot of the Data Brent physical differential, as it goes ups and downs depending on the supply and demand dynamics, the trading, the positioning of the physical guys. Recently, we've seen a big,
It's like a
collapse.
CTA graph.
Almost, yeah, almost. It's just a bit of a seesaw effect going on. Recently, people.
Let's just quickly explain this for people who don't know, right? This is, again, it's not easy information to get. You can get it from us. But this is the physical differential from a Platts perspective, right? From the PRA perspective. This is what they're using to set the price for dated Brent, which in turn will set the price for all the differentials and then ultimately Brent time spreads. So generically speaking, even if you've got no interest in trading some of the dated Brent contracts we have on Flux, etc., you should still look at it to get an indication of what the physical differential is. And that will link very tightly to the Brent time spreads. And the Brent time spreads in turn will give you a good indication if the market is strong or not. So that's why that's so important. Basically look at this like a time spread. Yeah, so we've been going from negative 3 times in the year to incredible spikes. Again, this is what's just nuts. It's like Brent Dubai. It's like you would expect in a typical regime, you're either strong and you're kind of 40 cents to $1.20, let's just say. That's a very healthy, strong physical market in my experience in 13 years.
Yeah.
Then what will happen is it will reprice and the range will be $1 to 40 cents. And that's how it goes. Just like I was saying with Brent Dubai. And you see all the correlations in the wider market. It might be a bit choppy, but ultimately the market's either strong or weak, basically. This year, we've gone from pretty damn weak. 50 cents. It got down to 50 cents again a couple of times more recently. Okay, genuinely a regime of bearishness.
Yeah.
To a flip to unbelievably bullish. It honestly does blow my mind a bit because it just shows you flipping from so bullish to so bearish and flat price kind of nicely trending down didn't really make sense. It just shows the chaos again. We're kind of repeating ourselves, but that's what I get from this graph. What else would you say?
Yeah, it's just lots of ebbing and flowing. It's just more recently in the last 2 months as talks of the oil glut, the increased supply narrative comes back online. As our viewers might recall, for October, November, Brent futures expired. Retail took on a lot of barrels, and then also so in recent weeks, the physical was quite supported up to $1, and you had headlines coming out from Bloomberg saying, it kind of almost goes against the narrative of a supply glut, but then the physical differentials came off into the last 2 weeks as as the market became a bit more oversupplied, cargoes were struggling to clear. And but then all of a sudden recently we still need to update this, but the physical has been rallying again. It might be a bit of a short covering.
It's on its way up, and you can get an indication from the CFDs, data Brent CFDs, not to be mistaken with retail CFDs. This is the CFDs and data Brent, and they're interesting to track because you can get a forward indication of what the physical differential is going to be, or at least the market's interpretation of what the physical differential is going to be. And that is looking strong. That's looking like it's going to bounce back up, which does make logical sense. But I massively agree with you. The supply gut story has always been here. It was concentrating in the last few weeks. And one of the major reasons was this sell-off here. This sell-off in physical differentials, one down to negative, was the more classic repricing you would expect. And I was really genuinely expecting, right, here we go. This goes down negative. Every time spread in Brent is not deeply backwardated, deeply contango, but meaningfully contango, minus 10, 15 cents, 20 cents a spread. And there was only one spread, or maybe Jan Feb as well, slightly, two spreads to go. And it's over. It's a contango market. We're in a regime. That is what you'd expect. And it did look like Brent Dubai was it kind of started to make sense. Brent selling off, Brent Dubai picking up, physical differential selling off, and then bang.
Yeah.
For fuck's sake. That's why I say I struggle to believe that people made a lot of money on this, because you are looking to trade this repricing and it's all making logical sense. And then you get a black swan event. So you pick up again. The question's going to be, in everyone's mind, do you get long? So to your point, VTOL buying a hell of a lot of cargoes expiry, other trade houses owning oil here, they've gotten super lucky, right? They're gonna do very well. Fine, that's the way the game goes. But having said that, once it prices and you've made your money, are you going to get long again? Are you going to genuinely take on the physical again and expect this market when you know how vulnerable it is to a sell-off? And all you need is to Trump to tweet at 12 p.m. or 12 a.m., whatever, and say, I've agreed to remove sanctions. all that oil and water, like I said, Iran on steroids. Whenever it would be announced back in the day that Iran sanctions were going to be relieved, you knew all that oil was going to go find homes. It was unequivocally a bearish event. It's that so much more. We've got so much oil and water. If you remove the sanctions or a peace deal is made, I mean, it's like 1 billion barrels. I don't see how oil doesn't go negative again, or at least threaten to in a short period of time whilst the market reprices and clears this oil. You might not see oil negative in the benchmark prices, but you will for sure see a lot of people struggling to get rid of the oil and paying people ultimately to get it cleared so we can start again. So honestly, I wouldn't put it past the market to price incredibly strongly in the next few weeks, rest of the year, but then also be vulnerable to an incredible price dump. So I mean, buy volatility, I guess, is the only thing left to really say on that side of things.
Yeah, for sure. Buying volatility and the post-sanctions trade, there's going to be a lot of adjustments being made. That's for sure.
Yeah, and you know what? Even as we're saying this, it's a Friday. What's the date? Whatever we are. We're launching next week. This will be online and part of Flux News. Man, think how much could have changed in the next 3 days. So look, just so the audience knows, we were on a Friday, just only a day after the sanctions were announced, or a couple of days after. So we don't know, but it could literally be the weakest market ever or the strongest market ever next week, which is nuts. But yeah,
for sure. Another really important, some interesting, a bit more niche chart I want to bring your attention to is looking at the actual physical differential versus how the data Brent, how the forward curve was priced a week prior to expiry. So that's for the weeks.
This is data Brent implied. You're looking at the CFD curve, right?
Yep.
CFD curve, the market anticipation of data Brent versus actual. This is a great graph. Yeah, thanks. Sorry, just wanted to make that clear. Go on.
Yeah, so on the left side, that's what was implied on the CFDs, and that's blue bars, and the orange bars was the actual physical differential, how the actual market was priced. And over the period of summer, there was a period where refinery margins were super strong off the back of stronger distillate cracks, gas oil cracks. And so the narrative was that triggered a lot of refinery buying, especially in July and August. So hedging the cargoes on paper. So the paper implied was really high, but when it came to the actual physical pricing,
but when is the snapshot? So is it like 3 weeks forward?
1 week forwards.
1 week forward, but you could even go 3 weeks forward. That would be very interesting as well, because 3 weeks forward, and if you go to like 13, 17 week in October, people were pricing that at plus $1. It priced minus 50. So that's when, again, that's another signal to be like, bosh, the market's cracked.
Oh yeah.
So
sure.
yeah, but your point is what? That it just struggled to actually reach the heights.
Yeah, for sure. So during a full period between July until September, it's if I have the numbers right, the actual physical was weaker than implied for 14 weeks in a row. So in theory, if you were to short the 1 week roll into pricing, every single week would have made money for
but
3
again
months straight.
That's a very nice physical signal. Sorry, a bearish signal. I'd be looking at it's really struggling to keep up here, and it just re-emphasizes the same thing we're saying. But there's great analysis. Like, I think it's a shame you don't have that week, because I could show that. But other than that, like, you need to get this out more in the reports. Like, people should be clambering over you for this information. It's not easy to obtain, but you'll supply it, won't you, Vincent?
Oh, for sure.
For a cost.
For sure. So lastly, refinery margins looking forward. Of course, it's closely linked to how the demand dynamics in the data Brent market, and margins have been creeping higher since the start of the year. This is the M1, and gasoline cracks, diesel cracks have all been really supported. So, and in line with this, we've seen physical strengthening off the back of the sanctions news, and margins are pretty strong as well. So this makes, at least from my perspective, a bit more bullish going into the winter time, especially refiners coming back out of maintenance. There's going to be a bit of demand coming online, as well as the fact that if margins are in a high environment, then some refiners may be looking to defer their maintenance schedules come spring. So there's very much a bullish thesis for data going afford if you come.
Well, and as you saw on your previous slide, like you said, the refiners are buying those CFDs to hedge this kind of thing. And you get the indications, it's got real paper impact on the dated, which then impacts the Brent spread. So don't think that that's irrelevant. Right? That's super important. I agree with you. I just wanted to add, going into the year, reasonable margins. This spike, the market's been pricing on a refinery margin basis as if the market has, or the world has a lack of refinery capacity. And to some extent, that's probably true because of Russia being bombed, maybe that kind of thing. And China probably not running their refiners anywhere near what they're capable of doing, like more like 50%. So it kind of makes sense, but it's also pretty crazy. And I agree with you. It's hard. It's a very bullish signal to have such strong margins. And for them to be up in this is European, remember, not Asia with the sophistication. This is European crappy refiners making a hell of a lot of money. They've all been wanting to sell their refiners for like the last 10 years, but you've held on to them. You would have made money, quite a bit of money. And I think when it's as high as $9, it's so hard to look at that and say, are we actually in a bearish market? And then, but to challenge that a little bit, we were selling off. This sell-off, the latest sell-off from 950 down to close to 7 was happening with the physical diffs coming off. Just to repeat myself, everything was coming in as you'd expect. And the problem with margins is if the demand is relatively healthy, but you've got an oversupply story, then you can justify having low crude prices and high margins because the products just are a bit more sticky, but the crude is getting, so it kind of makes sense. So you justify to yourself, it's okay. It makes sense that margins are high because crude's weak. But the problem is, can you really get a proper sell-off if their demand is still kind of sticky? And we've seen a considerable amount of consumer hedging at every point at every major sell-off. The tariffs, that sell-off we talked about earlier. Do you remember we were talking about this podcast earlier on in the year? Like insane amount of consumer buying from fuel oil. Then we got to recently with the sell-off when we got close to the 60 figure, the most ever jet fuel consumer buying, people are saying, from a hedging basis, like really, really concentrated buying, like quite unusually so. And that does have a bullish impact on the margins and the overall flat price. So what I'm saying is a real sell-off, if you like, will be completely undeniable on a margin basis and on a flat price basis if there is a demand shock. So that's maybe been the problem, if you like, for the market to not really follow through on this bearish move. I think we've got to see the recession that people are talking about. UBS was saying it's like a 93% chance of recession now in the US. Okay, well, if that's the case, then you will get demand destruction and you will see these margins weaken. And once these margins are down into negative territory, it's going to be the complete flip. There's going to be a lot of reasons to sell off and to not hold up. But we're nowhere near that right now.
Yeah, for sure. So very much an oversupply story. That's the narrative of the past year. So demand has been keeping up, but there's just been more supply coming online.
Yeah, but like you say, like when you have shocks and you have maintenance being over and you've got refiners for reasons to buy the paper, it's hard for there not to be a big bullish impact. And then when you have CTAs max short and the market's so short, it creates vulnerability to these market roofers that we've periodically seen. And that's, I mean, I think we've done hopefully a relatively good job there over the course of this podcast to really emphasize when people say it's been a difficult market, this is why. Because you get it a lot. It's been volatile. Surely it's been easy to make money trading. And the CEOs of Gunvor and Vitol and stuff were asked this as well. Like, how's the market been? They say it's just been very difficult. And people generically don't understand what that means. This is why you get this bullish signal versus this bearish signal. You've got oil and water versus very tight free markets. You've got all these things going on. You need kind of, yes, volatility, but volatility around kind of correlated indicators that over time can create a regime shift or a repricing. That's what the market was looking for. It didn't get it. So you're getting winged and wanged everywhere, and it's very difficult.
Yeah, I suppose like the difficult kind of volatility, especially with the US administration comments and stuff as well.
Yeah,
usual
100%.
Yeah, all these changes.
Yeah. Cool. So should we finish maybe just quickly? As I said, we are doing this podcast only very recently after the sanctions have been announced, the latest sanctions, and a lot could change. But going into next week, should we put some predictions in place? What do we think is going to happen? How do we think things are going to pan out?
Yeah.
Go on then. So we got the CTAs probably still need a lot to buy back. There's a lot of capacity for them to buy back. We've got refining margins, very strong. We've got the Russian refiners still getting bombed. We've got a lot of bullish reasons, and we've got a big paper unwind from the market being so bearish for so long. the longer these sanctions maintain, the longer the market believes in them, the more time the market has to flip their positioning materially long. So I think it's obviously contingent on that, but I think we can easily go back up to the 70s here, and it could be a very decent bull run. Brent spreads, basically a full bull narrative. That would be my prediction if things are going to stay as they are.
I think so, yeah. But to speak of what might happen on the opposite end, if Putin comes to the table quickly, and US have mentioned publicly that potentially sanctions relief for freezing the front line, all of that as negotiating tools. So if that comes out, these headlines come out, then we could also see a rapid unwind as well. So as to we need to look at, like, the traders need to set stop out levels very cautiously.
I think so, and I think momentum trading could work. But remember, when you get bullish and you get volatile, it's tough.
Yeah.
You get chopped in and out of trades. My take would be trading from the long side, but the higher we go, start to pick up cheap put options. Because there's no, it's like a COVID event, right? If imagine being told COVID could happen. You're okay, I'm going to buy some fucking $20 puts, because if it does happen, it's going to really aggressively get there. I think the market is signaling that to us. It's saying, right, trading for the long side. But if Putin makes a deal with Trump and like it's happened overnight, then you really can, with all that oil and water, go from 75, 80, I don't know how high we're going to get, 85. You can genuinely go down to $30 with how much we've got, and how much positioning and how much carnage can happen all at once. So the only trade there is long volatility. So you have to own an option, you have to own an out the money put, and you have to, obviously, when that happens, price in the volatility roofer, maybe at that point, take it off and have a short position, whatever. The point is that could very easily happen. That might become a crowded trade, but basically long outright, the higher we get, the more you're buying out the money puts, will be my thing. And you could do the same with time spreads. You can buy CSOs on Brent spread puts. You can say, as we get to $1, $2 backwardated on Brent, if that's going to happen, you can start to look at the deferred curve that's been dragged up and start to buy, minus 60 or minus 40 put options on the spreads. That would be my take. I wouldn't do it in gas oil, because gas oil has still got that Russia situation. It's still got all that consumer buying. Clearly there's still demand. But at the same time, if there's a macro sell-off and there is a recession that comes in and all this gold unwind and everything, that kind of stuff, then yeah, you could get washouts everywhere. But that would be my take. Anything else to add?
Yeah, I think with these hypothetical trades, one would be covered on both sides for sure. So you can, like, on the rally, flat price, right? And then if things go the opposite side, then the puts will have you covered.
Yeah, I'm not trying to say buy when the market goes up and sell when it goes down.
No.
I think the market will go up as it is right now.
Yeah.
But because of the shock decision, the best way to trade a shock decision is to have a put option. And actually, if you had them in the tariffs, like I was saying, you got paid very quickly in 2 days, and then you're out of it and you start again. That if you're not in it, you'll lose it. You know what I mean? There won't be time to sell on the way down. It will be too aggressive. So you're going to need that insurance. Great. Vincent, thanks very much. That was very thorough. And thanks again, viewers out there. See you again soon.
Hello, welcome to the official Singapore market on close. Now, today in the Dubai window, we had kind of a slightly quieter window than yesterday, but more of the same players coming to the fore. So really, we've got Trafi and Totsa driving the buy side. Sell side is really Exxon and Unipec, but also a lot of the other Chinese players like Sinochem and Hengli. And that's a big focus at the moment, given the expected rotation from China to buy more Russian, maybe less Middle Eastern. So them being sell side is an indicative sign of that. The other focus is really on Reliance. Having bought a lot of Middle Eastern, particularly Ahwazakan cargoes recently, they're now apparently selling some of those again. And there is a lot of focus and a lot of scrutiny on what they are doing in Dubai. But in terms of the physical premium, what we had today was pretty much a consolidation. Yesterday we were assessed at 96 cents, today 97. So it's really pretty kind of stationary in that sense in terms of the structure on the physical side. But as I said, we have the two main buyers coming to the fore, being Totsa and Trafi, and the two main sellers being Exxon and Unipec. And so far what we've seen this month are two convergences, both going to Trafi. Yesterday from Unipec and then today from Exxon. Totsa yet to get a convergence, but they are getting close. So we expect they will get one within the next few windows. And of course, I mentioned that the physical premium hasn't strengthened too much. It's 1 cent higher, so nothing significant. But if you look at the futures market, Dubai and the structure as a whole does seem to have firmed up this morning compared to yesterday when it was extremely weak. So what we have here in the Brent Dubai chart, you can see back over on the left-hand side, around this point here, we have the jump on Aramco OSPs, which saw Brent Dubai rally quite significantly, but that has since fallen off and we're back basically to where we were before. So if you just cut off yesterday, we're at the same place we were, around minus 80 cents on Brent Dubai or M1. And then in terms of Brent itself, we've had a recovery this morning in terms of the flat price. So you can see on the chart here, you've got a bit of a strengthening of the January futures contract up to around $64 this morning. Had a bit of a wobble going into the window. You can see around this point here, but it's strengthened since, and we are looking at that $64 handle again. So that's quite a sticky area, even if we are going up and down, bobbling along. But 65 looks a little bit out of reach for the moment. More seems that we're in kind of just 64, just sub 64 kind of level. But what is interesting this morning is particularly this rally that we've seen in the prompt spread, because yesterday we saw it go down as low as 20, 21 cents, and that was the weakest we've seen for quite some time. Whereas this morning we've had quite a significant rally. We got up to, if we look to the candle chart, we got up to a high of about 38, 39 cents. Has come off a tiny bit since then, but significantly stronger than yesterday, given we saw yesterday a weakening of the Dubai physical premium, weakening of the Brent futures structure, weakening of dated Brent physical differentials as well. So yesterday, the story was all about weakness. Today, a bit of a consolidation, bit of recovery. And again, that focus really is on the Chinese and reliance in Dubai.
Well, Chris, thank you very much for joining. Thanks for doing this. You're the first interview we've got in our new series. So thanks again.
Well, excellent, Greg. I'm very happy to be here. Thank you.
So I guess where I'd like to start is your book, Understanding Risk Management and Hedging in Oil Trading. One thing that stuck out straight away when I read it is you make that really clear point about, of course, there's price risk and there's hedging in the classic sense of how people think about it. But a lot of risk is moral, it's operational. There's so much risk to risk management than just the price. Was that something, and then you also said at the end, kind of a lot of the reason why you wrote this was because people just seem to know next to nothing when they come in. There's no real literature, I guess, to get a sense of it. And I guess for you, did you realize this straight away in your oil career, or is this something that you kind of developed, you found over time that was something structurally people didn't really grasp, if that makes sense?
Well, structurally, it was something I didn't grasp when I started out. I started out back in the early 90s with Total on the Middle East, East Africa subcontinent desk. And we didn't do hedging. We didn't understand market structure or anything. We bought and sold based on bill of lading dates. And even if the cargo floated around for 3 months, and if the market went up or down, it didn't matter. You just resold it based on the price at the loading dates. So I didn't understand any of this for the longest time. And had no formal training in this. My background, at least my education, was economics and politics. So I didn't really study much in the way of business. So I was plunged into it, and I don't think I was terrified because I really didn't know what I didn't know. So when I wrote this, it was designed for people who had no clue, essentially.
And I guess that speaks a lot to how the oil market has developed, because again, from my understanding, the early days that you're talking about in your career, I guess the volatility was a lot lower. Is that fair to say?
I don't know if volatility was lower. I think the markets were in general a bit more naive. If you look back at the history of technology and information and also derivatives, the first oil swap was 1985 or 1986. I can't remember exactly which year, but around there. Yes, we had futures, but the markets closed at whatever it was, 530 for gas oil futures, and I think 730 for Brent and then WTI. And after that, that was it. There was no market. There were no portable phones. On the weekends, people disappeared. So in a sense, there was no need to be overly sophisticated because there's very little you could really do in the market.
Well, that's fascinating. I guess with the benefit of hindsight and where we are now, imagining that is crazy. But of course, as you say, like that, the market was like that. So I'd be very interested to know, what was the turning point then? Is when people started to notice? Was it like a big price move, big loss somewhere, or where was that big shift?
I think one of the big things that changed was simply the technology. Once people started getting portable phones, you could be reached at any point 24 hours a day. When I worked in Singapore, I was commonly woken up by the office in Connecticut at 3 or 4 in the morning to talk about the market, as if I knew what was going on at 4 in the morning. But that also allowed people to start trading 24 hours a day and manage positions much more efficiently. Then, of course, with the internet and feeds over, I guess, first BlackBerry and then smartphones came along. And suddenly you had the market in the palm of your hand 24/7, and you could pretty much always find a way to hedge or find some derivative or something to do. So I think the big change was technology more than some sort of volatility or event.
Right. And I think when you say the technology, I guess, would you also say it was the derivative market developing on the one hand, but also that derivative market being visible through technology, right? That was a new thing.
There were markets that existed, but I think most people didn't really have a clue about them. Some of the early markets, European trading, worldwide, the Brent market, and even today, I don't think most traders in the market, certainly not product traders, and most crude traders outside that market, really have a grasp of what goes on and the derivatives and the things that are traded in the dated market, for example. So with more technology, there's more transparency, and people began to understand.
Yeah, understood.
I hope they understand. Those are in the market.
Yeah, it's fascinating to me how this is, I don't know if it's the only market that's done this, but it feels like, given its specialism, the oil trading market really has been designed by the traders. They've had problems like lack of transparency, or even things like you're saying, like bill of lading. There's no perfect hedge, like you say in your book. But the traders are always working on trying to find more ways to get closer and closer to that perfect hedge. And I guess I'm still curious, is that desire to do that? Why would there have been that desire if the market was naive and still functioning well? I guess someone must have made some more money being a bit more precise and sophisticated, and just goes from there.
Yeah, this kind of history of derivative is not really my field. I mean, someone like Adiyam Sirovich probably knows
Yeah.
a bit more about it. But I think it stems from the banks entering the market,
Right.
just liquidity, transparency, and then the information technology. And once that became available, oil trading companies and oil majors who were trading decided that it was prudent. I know that at Total we had some, one of my first encounters with something called a backwardation was a cargo that was not really hedged because we thought we were selling it. And in the end, the buyer flaked. He just disappeared. He didn't want to do the deal. And we ended up having to hedge it on Singapore futures for fuel oil, of all things. Doesn't exist anymore. And I learned what backwardation was, because the hedge ended up costing us $3 million. So a cargo went from plus $1 million to minus $2 million, literally overnight. So that was a big lesson for Total.
Wow. Well, yeah, as I say, it's always interesting to hear it from someone who was there at the beginning, because it's always evolving in real time. So I guess from a risk management perspective, I mean, it's very clear, obviously, that the evolutions have been dramatic and ongoing. But maybe if we zone in a bit, like where do you think it's made us? Obviously, the technology came in, but did something like from the physical side, let's say, I guess getting more into, let's say, the shale oil boom, for example, in the US, like you see. Risk management, at least from my perspective, seems to be a huge way to how that market's even built. Like my understanding is shale oil, to get the resource-based lending and to be able to start, you need to be forward hedging, and that was seemingly for me like a new thing. Would you agree that since the shale oil boom, or the shale oil boom, there's a lot of evolution in the risk management in the US side particularly?
I'm not sure if it's an evolution. I think it's a question of practicality. When you drill in a standard conventional oil field, you're looking at producing from anywhere 20 to 100 years of production. And you can try and hedge that, but realistically, how are you going to hedge 5 billion barrels forward? It just can't work. While a shale well, it's going to produce for a couple of years, really, maybe 3 years at this point, before it really depletes. So it's relatively cheap in terms of investment, and it's relatively short term as well in terms of production. So it makes much more sense for them to go in and hedge. I don't know if shale, that approach to the market, hedging particular wells, drove hedging, or it just went alongside it. It's certainly true that these days, unless you're the owner of the company, you're not taking flat or outright positions anymore. It just doesn't happen. Everybody runs nearly flat book. No matter how big their exposure is, at the bottom of the spreadsheet, it comes down to zero, or as close as can be. But I think that coincided rather than was being driven by the shale boom.
And I think to your point about it being some of these smaller wells and independent traders, I guess that's it's something I thought about a couple of years ago, actually, particularly around 2022, when we kind of lacked a lot of the hedging from shale oil producers, because they were out there saying, look, what do you want us to do when every bank is calling for like $150 oil? Why would I hedge, right? And that's kind of a fair point. But the other way to think of it is when shale oil independents got absorbed more through acquisitions, and it feels like, and again, this is not my expertise, this area, but it feels more like it's much more consolidated, the shale oil and the independents, and the Chevrons, the Exxons, and they must think, as you just said, that they're such huge players. They must think of hedging and risk management in this area very differently, right? That's a fair point to make.
If you take someone like Exxon, who had a foray into trading, it sort of fell apart. Now they're coming back again. Exxon never hedged. Up until 2018 or so, Exxon never executed, as far as I know, maybe just on a whim, a swap or a futures hedge or any sort of hedge. Exxon said, we're too big. what are we going to do? We're just going to move the market one way or another, or we're long here and short there. What's the point of hedging? We're global. So the oil majors tend to have the same approach. Again, I've only worked for one major, that was Total, but I know what happened inside Total. They didn't generally hedge their big exposures on equity, oil in the ground, refining margins, those sorts of things. I think most of the oil majors and large producers, national companies, whoever they may be, look at it and say, we're in this for a very long term. We're going to make money doing this in the long term. In reality, oil is free in the ground. So the only cost is the price of production, the cost of production. So in terms of hedging, it might apply to something with a very high cost like shale or oil sands, those sorts of things, or even perhaps in the North Sea, where you're starting to hit up toward $50, $60 a barrel production. But for an oil major or a national oil company, I don't think it makes sense to even try to hedge. I don't think the liquidity would exist for them.
Yeah, it's so interesting. That's such a good point. I mean, and I think that if I'm speaking as a derivative trader now, when you're trying to gauge the physical versus what the benchmarks are doing, it's so easy to say, but the refinery margins are strong, and the cost of production versus where the price is economical. We should see more oil here. We should see more oil there. But how it actually translates into the price is a function of people actually clicking the button and trade, right? And if they're not doing it, how that filters through from basically what the physical market is doing into the paper, that's where the dislocation is. And I personally see that as like one of the biggest misconceptions when you're thinking about analyzing the derivative market versus the physical. But I guess in your perspective, do you have a similar view on what people misconceive generally with risk management or do you look at it completely differently?
I'm not entirely sure. I get the point of that. I sort of see where you're going.
Sorry, no, I'm being difficult. So I guess what I've got here is, the biggest misconception about oil price risk from the difference between a corporate manager and a fund manager, right? So a corporate manager, like you just said, would be thinking it like, we take a long-term view, we're in this market for a long time. Whereas a fund manager is saying, well, the physical's doing this, so the derivatives market's got to do this. It's like that's a big difference, right? You see what I mean? How people look at the markets.
I'm not entirely sure just how in touch with the front end of the physical market the fund managers are. The really sharp end, the first couple of months or 3 months. So they're looking forward for more macro things. OPEC decisions and new refineries coming on stream, that sort of thing. From a corporate point of view, as far as I can see from people I've worked with, companies I've consulted with or companies I've worked for, you build a refinery, it's notionally going to last 100 years. And you're in the business because you think you have good engineers and you understand the market and you're building something that's going to be profitable. So I don't think they generally go into it thinking, well, I'm going to build this refinery and hedge it, or I'm going to drill for oil here and hedge it. It's a very long-term approach, and I think they approach it simply as a business. The same way a baker doesn't hedge, his wheat input and his loaves of bread output. He's just in the business thinking he'll make a margin.
Yeah, no, that's exactly. I think that for me is one of the biggest problems people on the outside of the physical have. They want to believe that if there's something happening in the physical and that they're aware of, it should translate into the price. But there's so many different ways of thinking out there. People in the physical world don't look at derivatives like the be all and end all, right? They're looking at things potentially very differently. And like you say, like if people are taking macro views, no wonder things get distorted, because it's just like one economic model versus a completely the other. But just for someone starting out then, I mean, that's a very confusing kind of thing to hear, I would say. So of course your book's a great start. I mean, you get a good overlay of how people are thinking and what they're actually using the derivative market for and what they're using risk management for. But do you mind if I just ask, like, what is your advice for young people given the state of the market right now?
Well, right now it's a difficult market today. The market's volatile, but non-directional. So that makes it confusing for a lot of people right today. So I think a lot of people's views in the market today are a bit skewed by what's happening today. It's harder to get into the market than it used to be. I started out, I was hired, I had no background really any serious background in business, finance, accounting, or anything. I really didn't know what I was doing in the beginning. And I was plunged very quickly after practically no training onto a trading desk and let loose on the market. That doesn't happen these days. People are hired by companies, whether it's a Vitol, Trafigura, Mercuria, or an oil major, and they go into pretty extensive training programs, passing through the back office, middle office functions, sitting as a desk assistant. And it's getting hard to get in because, for a while after the various crashes and COVID and what have you, Wall Street lost a lot of its appeal with restrictions on bonuses and salaries. And it's become very corporate. So people turn to Vitol and companies like that because they saw the headlines, billions of dollars in profit. So Vitol, now the oil majors who have trading desks and whoever, can pick and choose from the top business schools. So they just make a selection of, here's one from MBA, here's one from Harvard with an MBA, from Stanford, from MIT, whatever it would be. So it makes it difficult for people to get into the market where they are familiar with it. So my advice to young people is, if you want to get in and become a trader, then you need to probably start somewhere smaller or start somewhere else in a larger company. But the idea of I'm just going to go and get hired and become a trader and be driving around in my Ferrari in a year doesn't work that way anymore. But there are other ways to get in. Broking, working for an inspector, working for a storage company. There's lots of entries to the market where you can start to learn and see who's in the market and do you want to do this or not.
Do you think there's a big difference between the US and European life or work in oil?
Oh, I don't know. I've never traded in the U.S. I've only ever, I left the U.S. back in '88 or whatever it was, and I started working in trading in Paris, then London, Singapore. So I've never traded in the U.S. So I don't really know.
Yeah, no, it's interesting. It's just some of the way they think about hedging, like you say, in the bigger companies. It feels like maybe they're not behind anything because they're huge and sophisticated, but they've certainly not looked, like you said, they might not even hedged ever before with some of these companies, but they don't see the need to. And I wonder, that dynamic must be very, very different being in a US based firm in oil than UK. But as you say, like it's hard to know without having actually done it.
There are differences if you look at, historically at least, hedging by someone like an airline. When I traded out in Asia for some of the banks, trading options, basically marketing options, running an options book for airlines, they were willing to do very exotic options, highly leveraged options, 4-to-1, even 5-to-1 collars, those sorts of things, leveraged three-ways, what have you. And they could do that because they didn't have any restrictions from an accounting point of view. While at the same time, U.S. airlines could really only do fairly simple hedging because otherwise accounting and regulations and reporting restricted them. They simply couldn't do it. So I think the U.S. corporates are probably behind in that because, which might be a good thing, frankly, from my point of view, simply because they weren't allowed to do it. It would be too onerous from an accounting point of view.
That's very interesting. I mean, there's been some interesting books. I don't know if you've seen the Secret Club That Rules the World. That was the one a while back, and there was a story. They went through all the Delta Airlines buying a refinery and things like that. All these inventive ways.
People, companies have gone in. I was involved in, my students or the participants of my courses always ask me, what's the most money you've ever lost? And was involved in one of the largest trading losses in oil trading ever. I left the company well before it all exploded. But I worked at a bank in Singapore and we marketed options to I'll call it developing country national oil company for their refining margins and other things. And when I did it, I told the company that this was a big mistake, that we shouldn't be marketing this because the client didn't know what they were doing. But they went into it. We sold them a bunch of options. Other banks saw what we were doing, followed them in. And it turned into, I think, a total of about $800 million in claims. Much of it was paid out, but it's probably still $300,000 or $400,000 in losses for the banks that were involved. So, yeah, not everyone's completely sophisticated. This wasn't that long ago. This was 2000, 2007, 2008.
Well, I guess that was the time where the banks were probably at their peak, right? And I guess they finding inventive ways as salespeople to get people to hedge, like you say, there's collars, there's leveraged collars. I mean, these days, I think there's a general understanding like that stuff can get very dangerous. But hasn't deterred people from hedging, but I personally don't see as much of the non-vanilla structures. But I could be wrong. I don't know. Maybe you see something different.
No, I'm not in the market doing that anymore, so I don't really know what's being marketed to these companies. For the most part, when people ask me for advice on hedging, I tell them to, if you don't understand what you're doing, you probably shouldn't be doing it. So one of the reasons that these banks, and now I guess the trading companies, even the oil majors, have desks doing this, marketing these things. The reason why they market more and more exotic options, leveraged options, knock-in, knockout, wedding cake structures, all these sorts of things, is because they got competition. Originally, it was the banks marketing straightforward caps and floors, and then became collars and then three-ways. And those are all vanilla. And as soon as you get competition, there's no more margin. So then you have to start building in something exotic where you can start, hiding optionality and hiding margins in there. I know it sounds like a very negative approach to the whole thing, but that's my point of view on it.
Yeah, sounds exactly right. And I guess it became also a function of financing as well, right? Like if more and more people are in the game and able to offer the same financing, it's less of an edge. So you've got to do it more with the structures. But yeah, no, it's interesting. So where do you think it goes from here? Do you think more and more people are going to hedge and take the view that it's going to become almost like foreign exchange, right? I mean, a lot of people are familiar with foreign exchange hedging, but oil and energy is way behind from a corporate sense from that point of view. Do you think that evolves?
I don't see the corporates doing that much more. As I said earlier, oil traders and the trading departments of any company are pretty much running flat books. So everybody's hedging on a flat basis. It doesn't mean they're not taking massive positions. You mentioned earlier about this possible disconnection between physical markets and the derivatives markets. Physical traders are hedging everything they have on a physical position, but then they go far beyond that, because once you've done your hedge, you've locked in your result. And how do you make $10 billion a year by simply trading physical oil? You don't. So they end up taking very large positions on various spreads and things. So they are trading massive amounts of derivatives, but at the bottom of the page, it's zero. For the corporates, I think that's been pushed far enough, and I think a lot of corporate companies have seen articles and headlines, and they're willing to do certain things, but they're a little bit more reticent about getting involved in too much exotic stuff. But again, I'm not in the market today. I might be wrong.
But it's just like you say, yeah, no, it's fair. But I just think, again, like with your book, it's not a simple concept, but I think the information out there is increasingly democratized. And I don't see why, at the very small scale, you can't protect yourself, even as an individual or certainly a small company, against things that do impact your business. You have very small businesses, but they have to use diesel every day, and their businesses can be really stung by diesel price spikes. Why can't these companies be more active on the hedging side? I would argue personally that it's not even considered an option because it's not been very visible. But I think that if that was the case, you could see a lot more, basically, is what I'm saying. And that's maybe where I see it going, but you might say it's just too different. I don't know. That's why I was interested in your opinion on it.
Well, I don't think they have the knowledge, as you said. It's becoming democratized, but a small company running a factory burning diesel, I don't think they think about hedging. Or if someone suggests that they hedge, they're going to go, oh no, I don't want to get involved in hedging. It's gambling, it's speculating. So it's a question of understanding. And again, one of the reasons I wrote the book was for people like that. Now, I don't know if someone running a factory in that way is going to actually pick up my book, because he's going to look and say, this is a book for oil traders and not for me. But it's, I didn't write my book for oil traders. They should already know this. I wrote this book for effectively corporates or HR or somebody who has no clue whatsoever. So perhaps if everybody bought a copy of my book, we'd see more hedging. I don't know.
Well, that's exactly what I'm trying to say. I think they should, and I agree. But I think that there's something about oil, though, is there not? It's so niche. Like even the bigger macro high frequency trading firms, they seem to really struggle with the nuance and the domain knowledge of oil. So what do you think is the hardest concept that's hard for newcomers to grasp who aren't professional oil traders?
One of the difficulties is it's a commodity. Crude. Well, let's talk about crude oil, because products makes it even worse. But crude oil is a commodity, but it's not just one commodity. It's semi-fungible. A barrel of WTI Midland, a barrel of something in the North Sea, a barrel of West African, similar, but not exactly the same, separated by some quality differences and separated by contractual terms and freight and logistics costs. So I think that maybe the big hedge funds are trying to look at this as a very, very big picture, and sometimes they miss the smaller moving parts. The market can be driven by micro things. In one market, what's happening in the North Sea? Is the Forties field shut down? Missing a couple of nominations or lifting coming out of the U.S. Gulf Coast, and misjudging the amount of exports or stockpile builds and things like that. So I don't think it's like gold trading. Gold doesn't do anything. It just sits there. People dig it out of the ground and then put it in a hole somewhere and just leave it. So it doesn't move. It doesn't physically move. And gold is gold, like most precious metals. It is what it is. But oil is different all around the world. And it gets even worse when you start to talk about product markets, because many product markets have different specifications, different ways they trade, sizes of cargoes. So understanding those flows are important as well, because, as you mentioned diesel earlier, in order to understand the value of crude oil, Brent or WTI, if you don't know what's happening in diesel markets, you're missing a significant part of the picture.
But I guess someone just they only need to worry about their product that they're consuming. I guess maybe another thing it's difficult is if we say, let's talk about the UK market. Why don't you go and hedge your diesel? You'd be like, okay, well, where's the UK diesel contract? That's also, and this, the different, the words are crazy, like CIF, Northwest Europe, like barges. It's like, what the hell does that even mean? I saw like Prince Harry on an ICAP charity day. He was saying that as confirming a trade. And he's like, what the hell did I just say? I think that's half the issue as well. Would you agree with that? Some of the nomenclature makes it harder.
There are lots of prices out there, and people don't necessarily know what they represent. And this is often, sadly, the case for some people who are in the market who should know better. They're dealing with these prices, these Platts quotations or Argus quotations, and they don't really know what they're made of, where they come from, how they're formed. So if you're looking, someone who's hedging their diesel exposure as a domestic consumer in the UK, first of all, 75% of their price is not the price of the oil. It's the price of taxes and duties and wharfage and customs and all these things, VAT. The residual bit is tiny. If the price of oil doubles, it doesn't mean that the price of their diesel into their factory doubles. So there's really no market for them. There's no derivative to cover domestic prices, or if there are, they're extremely limited and illiquid. So getting in and out getting in might be easy. Getting out is going to be a bit of a problem.
That's something I think we're working on, but yeah, I completely hear you. Yeah. Well, this is what I'm saying is in like, I have a lot of sympathy for someone saying, yeah, okay, fine. I know I'm exposed to diesel prices, but like, what do you want me to do about it? It's such a crazy, I don't almost think or feel sometimes it's by design that it's not simplified. I mean, you go on IG Index, they do have UK diesel. I think they do, or they have UK oil, I think. And I think that's essentially a tagline for Brent. And I guess it's a lot more relatable. I think the more we get at that, the more it's like, okay, I kind of get it now. And then they can pick up your book and say, right, what am I actually doing here? And I don't know, I feel like it's not like you have to, but it wouldn't be a strange thing to say, look, if you're going to constantly go to Japan 3 times a year, are you going to think about your currency exposure and convert it early? Yeah, people think like that. So I don't see why they can't with oil. So I hope people will think of it like that more in the future. And as I say, use helpful books like yours.
Well, it comes down to having, again, a derivative that fits your needs. If you say to someone who's got diesel exposure in the UK, well, you need to hedge yourself against oil price risk, and he goes out and hedges with something liquid and trades Brent futures, things can still go very wrong. That's far from being a perfect hedge. So until someone can find something, first they have to understand what they're doing, as you said. And most people, I don't think, really outside the market, don't really understand simple concepts, which is why on my book I've been both mocked and lauded for the cover of the book. You can see that It doesn't look like a
Yeah, I've got
typical
it here.
oil trading book, does it? With the smiley faces and frowny faces. And I said it's because it's not written for oil traders. It's written for
Yeah.
people who have no clue. So when I have little reassuring things like little smiley faces, so they can understand it in a very simple way. So first they have to learn and understand this stuff. And then they have to actually find a market that applies for them,
Yes.
which
Yes.
it doesn't necessarily exist for a lot of these smaller consumers.
Okay, so I guess final question for me: Do you have any view? Maybe not about the physical oil market. I mean, demand's still super high, supply is still super high. It's at least around for 10, 20 years. But do you see a big future for oil trading? Do you think it gets even bigger, or do you think it's getting different?
I get in trouble for this because one of the things I do is I teach oil markets, oil trading, logistics, operations, these sorts of things, contracts. That's part of my job. So I travel around the world doing that, and I'm in agreement with my colleague Adi Imsirovich, who I worked with actually in in Singapore for Sempra years ago, that we're going to run into a problem where we're not going to run out of oil. But we have two issues. One, we should probably stop using it. And the other is that ultimately there's not going to be enough to really have a trading market. So I think in 30 years, we're either going to have the decision that we're not going to be burning oil, which means no more trading of oil, or even if we are, we're going to end up in a situation where those who have it will keep it. And what happens to the trading market when you have, for example, Saudi Arabia producing 6 million barrels a day or something like that and using all of it domestically, and the same for the other large producers. So, people ask me, how long will this market last? And I don't really know. But based on what I've read and studied, my best guess is effectively 30 years, maybe as short as 20. So if you're a young guy or a young woman getting into the market today, you've got to make as much money as you can in about 20 years, because after that, I think opportunities, at least directly in physical oil trading, will probably be limited.
But at the same time, there's a lot of lessons to be learned in any trading field to another. But I get oil, again, like I said, it's very niche and domain. There hopefully will be some decent translation of knowledge into another market, right? I mean, that could well happen.
Well, the fundamentals apply. I wrote my book and I talked about hedging and oil trading because that's what I know principally. I have taught classes at business schools in France just about commodities in general. So, someone said, well, do you know a book about natural gas trading? I said, well, just take my book, and every time it says oil, just white it out and write natural gas, because the fundamentals apply: long, short, hedge, all these sorts of things. All the other things I talked about, moral risks and legal risks, they apply across the board in any commodity. So yeah, once you've acquired the skills in oil trading, you should be able to move across to almost any other commodity, or even most other financial instruments. I've known traders who've gone from trading oil to trading ags or trading gold or even financial derivatives. So,
Chris, thank you very much for your time. It's very interesting. And again, your book, don't mind plugging it at all. Very good and simple, as you say, clear for people, understanding risk management, hedging and oil trading, a practitioner's guide to managing risk. If you're new to the market, great book to pick up and get cracking. So thanks again, Chris, for your time.
Thanks, Greg. Thanks for having me.
Hello and welcome to the latest episode of the Hedging Show. I'm Tom Fawcett and I'm joined as usual by Harry Campion-Evans. No Julian this week. I think he's on holiday.
He's on holiday. He's having a well-earned week off.
Yep, taking advantage of his newfound celebrity status. This week we wanted to talk about marine fuel hedging and why credit is an important aspect of that industry, but why, certain participants don't always know the true cost of that credit.
Yeah, we thought we'd sort of try and lift a little bit on the kind of, opaqueness of the credit industry and why it's so important in shipping anyway.
So I guess that's a good starting point. So why are these sort of shipping companies so reliant on credit?
So, as I understand it, in the shipping industry and like maritime industry in general, you have long payment cycles.
Yeah.
You've got a lot of operational costs which are paid up front, and generally it's quite a tight margin industry. You've got quite tight margins on sales of bunker fuel. It's very competitive, but I think more importantly, it's the payment cycles of the industry kind of lend itself to this kind of credit, methodology, I suppose, where you've got transactions need to be smooth at different ports. Like everything needs to keep moving. A lot of the cargoes that are being moved are paid for on delivery, whereas the fuel is being consumed on the journey. So you've got that kind of mismatch in, paying for something up front, but not collecting the revenue for what you're actually delivering until later.
Yeah. So I guess it's kind of similar to what we talked about before in the aviation industry, isn't it? Where you've got these like particularly low cost carriers operating on super tight margins.
Yeah.
Wanting to hedge out, a long way into the future.
Correct.
Because those margins are so tight, they need to be able to defend them, but they don't necessarily have the liquidity available to be able to fund those hedges.
Because as we kind of discovered, like the airlines don't get paid until the flight's actually landed. So that ticket you think you've bought for a year ahead, they have to kind of lock in the fuel costs for that, but they don't actually receive the cash from the ticket sale until the flight's taken off or landed. And it's just like the payment cycle thing. It just doesn't kind of match up. So if these marine fuel suppliers and consumers are paying upfront or depositing collateral for a hedge of something they're going to use in the future, none of that kind of cash that will be like a receivable they won't have any of that cash received. So there'll be a huge mismatch and they'll basically be operating as like a bank almost.
Yes. Yeah. So, and I guess it kind of brings us neatly on to why sort of banks have been quite dominant in that space, kind of, plugging that liquidity gap.
Yeah.
So they provide a lot of the hedging services, don't they? Even though they're not, natural liquidity providers in that space, they can leverage their balance sheets in order to provide the credit for these shipping companies to hedge against.
Yeah.
But they're not always, well, I'd say not always is a bit generous. I think they're very rarely transparent about the actual cost of that, are they? They're typically kind of showing an all-in price, which has got some kind of, markup.
Yeah, and it seems
baked into it.
Yeah, and that could be, well, again, we don't know always how transparent they're being with the customer, but it's not just the kind of, there's obviously the bid ask they have to cover and the internal cost they have to cover, but there's also kind of credit risk. There's all these layers of like risk which they're trying to bake into one price. And like obviously as you keep adding these layers of cost that they're trying to bake in, you just keep getting more opaqueness. Which suits the provider because they can just keep justifying like a wider spread. But it also, and what we've kind of also learned recently is that it can give the illusion that services are being provided for free.
Yeah.
And then it's like, you just pay this one cost and everything's free. And it's like, well how, because everything's not itemized, you're just saying, well, it's just a bid offer spread, but actually like it's not a bid offer spread. You're just kind of charging everything on the execution.
Exactly. And it's like all these things, nothing's for free. So it's like, if someone's offering you a, commission-free stockbroking, for example, they're making their money.
So that was the thing with Robinhood, right? It was like commission free and everyone jumped on it. But then it just turned out it was like at the post office when you do your money, it's just, you just get a crap rate.
Yeah, exactly. You're being shafted somewhere else basically, aren't you?
Yeah, exactly. And no one's going to lend you money for free.
Yeah. And I guess where the banks have been able to kind of take advantage of this in the past is there just a lack of transparency in this industry. The companies hedging didn't necessarily know where value was. So if you showed them a price that was, you know, broadly where they expected it to be, you know, they don't know whether they're paying, you know, like $1 a ton above value, or, you know, $5 a ton or $10 a ton above value. And that's why having access to something like the Flux platform is so valuable, isn't it?
Yeah, absolutely. I mean, it was not in their interest to give transparency, but it also, the fact that the business was going on for so, what is going on, just shows like how important cash is to these shipping companies. That, because you know, like we said before, a lot, the banks have this kind of synergy where they're often providing like trade finance to the shipping companies. So it's all, they haven't got these guys cash, or they've got collateral or whatever, and they're kind of happy to offer them credit to take on the derivatives trades.
Or they might even have some kind of like, you know, factoring arrangement or supply chain finance or something like that. And, you know, I guess the more kind of hooks they can get into
it reduces their overall risk. So they can kind of they can say like, there's, you know, we've got a lot of credit risk, but actually it's kind of negated in other areas of the bank. But yeah, either way, it just shows like that concept of like dead cash and what it's worth to the, you know, shipping companies. You know, would you rather not know how much you're paying, or would you rather deposit money in an account for to receive like a transparent price, you know, trading on the exchange or whatever, and, you know.
And we've had some conversations like that, haven't we, where we kind of, the people almost kind of know that they're being ripped off, but they almost kind of don't care because it's not like a, you know, an explicit charge. They're like, okay, well, it's just, you know, it's all baked into the hedging cost. And I think Julian's been very clear on this point in the past as well about how important it is to, you know, show your hedging costs and your actual purchasing costs, put those on the same balance sheet so you can kind of offset the P&L from both of them. Don't just be like, okay, well, we lost X on our hedge, but we, you know, procured this fuel brilliantly at a much lower price. You know, the two things should be netting off, and you've got to kind of look at everything holistically to understand.
But it seems like it's easier to swallow when it's just a bid offer spread that you're crossing, because there's no kind of like, there's no sort of notion of like money being handed over. Whereas if you itemize costs and things are kind of charged separately, then all of a sudden there's an issue, even though it is more transparent and you're getting a tighter price. People would almost rather just not know and pay their wider spread.
And I think there's quite a lot of research around this type of thing, isn't there, in terms of like trader psychology. And, you know, people would much rather take a kind of, you know, percentage chance on a larger possible future loss versus like a kind of guaranteed smaller loss now, even if the odds are against them. It's kind of human nature kind of pushes you towards that, thinking, okay, well, I've crossed a wider spread, but, you know, the market might just come back to me, rather than just locking in this kind of cost today, which is, I guess it's illogical, but it kind of plays into, you know, human psychology, doesn't it?
But I still think, but what we're trying to do, I mean, we've had a lot of feedback from the market, kind of what they find important, and actually it's increasingly obvious that there is a growing demand for transparency, and there is a growing kind of, I don't know.
I mean, it's kind of what we're all about here, right? They're kind of trying to shine a light on all of these things and kind of bring, you know, transparency, and, you know, we're showing people where our own traders are you know, see value. And, you know, in the process, we're probably making ourselves quite unpopular in various swings in the market.
But I think but whether you like it or not, that is just the way things go. And you know, that whole kind of opaque market, it just can't last forever. So, you know, we've always prided ourselves on being at the kind of forefront of that movement. And, you know, even if sometimes it appears that we're a bit early, and, you know, it's not always taken up so quickly, but we stick to that kind of transparent like ideology, and, you know, being very clear about what we're charging for things, where the bid offer spread is, you know, any other charges. We don't love the idea of baking things into a cost, but, you know, we know that that's what some people want, and we're a client first business, so
absolutely.
Whatever, we're happy to adapt, you know, and credit lines that we offer are tailored to what customers want, but we always try and push this kind of transparent angle where we really want to be upfront with, you know, we can charge a tight spread because we don't need these layers of middlemen, and we are the wholesale market. When you trade with us, you're facing that kind of Onyx liquidity pool, which is, they are the largest liquidity providers of oil swaps in the world, and you're kind of getting direct access to that liquidity pool. So we don't want to start adding layers of bid offer to that to make that not clear. But
yeah, exactly. I think, obviously we're a trading business. We've always kind of felt, we'd much rather make our money from market making, but we kind of appreciate the importance of, or the need for credit in certain areas. And where we have offered that in the past, we've always been very clear that, this is how much you're paying to trade. And if you're being extended any credit, then this is how much interest you're being charged on this credit facility.
Yeah.
And those are two separate things. So you can, how much you're paying for one thing, how much you're paying for the other thing. Whereas, the kind of bank model, by the way, that they'll probably be coming to someone like us when they need to flush out that risk anyway.
Yeah.
So you might as well kind of, cut out the middleman by not going via a third party.
Yeah.
But also, just be super clear that, if you could see that markup that's being added onto that price expressed as an interest rate, it might be quite eye-watering to you, and it might make you kind of think differently if you said, okay, well, this, X dollars a ton is actually like, 20% annualized interest rate. And you see it like that, it actually becomes quite offensive.
Yeah. And we've done the maths, right? And we've kind of worked out that actually, like, it doesn't take to work out like a kind of annualized interest if someone's trading regularly. The kind of extra markup is not that high, which is why we want to, we work so hard to provide tight prices. And then quite often, the question comes back at you, it's like, well, what's in it for you? Like, why are you able to show this? Like, what's in it for you?
Exactly. And it's just, for us, we're a market making business, the more flow, the better it is for us.
Yeah.
And ultimately we've always been of the opinion, right, that just an efficient market benefits everyone.
But it also shows you that kind of the criticalness of removing as many kind of intermediary layers as possible, right? If there's like $1 spread at the end of the line, but there's 3 intermediaries, all of a sudden you've got a $10 spread. Because everyone needs to eat. So we're about removing as much of that as we can, and that is why we can show that price, because we don't have 5 mouths to feed on the way down. We are this is the end of the line when it comes to liquidity. Like this is where the banks and the independent hedge providers are all coming to trade. So we just don't need to justify paying 3 different people to make the trade worth it.
Yeah, no, absolutely. And I think, I guess at the end of the day, whether you want to subscribe to the Flux platform just to view prices for the purposes of benchmarking, or, have a relationship with Flux markets for, direct hedging, it's all about just giving yourself as many tools as possible to make the best informed decisions.
Absolutely. Yeah. And I think we've kind of noticed that area of the market that was being served, particularly on credit lines, they were really kind of trying to pull the lever of opaqueness as much as possible, right? Because you want to kind of maximize the return. And we found, like, so far in this, relatively new venture for us, we've had pretty good traction with, these credit customers, because they are really benefiting from the transparency in price, the tighter spreads.
Yeah, I mean, that's kind of always been our sales pitch, right? Because you can talk about these things sort of academically, and it's kind of harder to get the message across. But we've always been like, okay, well, next time you go to your current provider to get a price, come to us at the same time, and we'll show you our price, and then just compare the two, and then it should be quite simple in black and white.
Exactly. Yeah.
All right, great. Well, I think that kind of wraps it up really for this episode.
Yeah, it was always going to be a short one.
Yeah, great. Well, hope you can join us again soon, and we should have Julian back with us next week. Thank you very much.
Cool. Nice one.
Richard Tice, thank you for your time today.
Great pleasure.
As we speak, the North Sea oil industry is going through another shake-up. We've got the Petrofac story. It's a complicated one because it's not really about oil exploration. It's about how you manage a company, isn't it? But does it add to the general mood that time is coming up for the oil industry in the UK?
Well, it increases the uncertainty and the fear amongst skilled, well-paid workers in the oil and gas industry across the UK, but in particular in the northeast of Scotland. It's come at a time when there's great uncertainty down at Lindsey Oil Refinery in the county of Lincolnshire, where I'm a member of Parliament, where there's thousands of families and jobs who are terrified and at risk there because that refinery is in receivership. And there's just a sort of ideological blind spot from the government. We know the oil and gas industry is it's a winner. Any nation that's got energy treasure under its feet, that has half a brain, extracts as much of it as it can. And it made Scotland, it made the UK very wealthy in the 80s and 90s. So yeah, families are very concerned. And this also comes on the back of recent reports that show actually, with a sensible, investable climate and a pro-oil and gas government that a reform government would be, that there are billions and billions of barrels of oil and equivalent gas that can be extracted offshore and onshore, and we should be extracting it as fast as we can. The multiplier effect of that is huge.
As we speak, we still don't know what's going to happen to those two oil fields, Rosefolt and Jackdaw, because of the Scottish courts intervening. We may get a decision in weeks, it may be months. What would your decision be if you had the chance to make that call?
Oh, I would allow those licenses, and we are meeting and have met oil and gas companies in Aberdeen and in London, and Nigel Farage and myself have said to them very, very clearly, a reform government will grant you all the licenses and exploration permits that you want, obviously subject to the usual regulations regarding safety, but we've said to them, get your applications ready. A reform government is coming, and get them ready in the year before. I've even said, in order to try and accelerate the process, we might look at having some form of shadow regulator that can, in draft, look at and approve any such license applications in the run-up to a general election, so that if we win a general election, then those applications, we know that they are basically pretty much oven ready, good to go. And you know, the people we spoke to are delighted by that pro-growth, pro-energy agenda. We're very clear, you cannot be a rich nation unless you have cheap energy. We were a rich nation when we had cheap energy. We're now getting poorer per person by the week, the month, the year. And the primary reason for that is we've got the highest electricity prices in the developed world.
And we just want to come on and explore why that might be. But just let's stay in the North Sea for a moment. The people who may stand in the way of your ambition is either the Scottish courts, again, may rule against any further exploration. I suppose it's conceivable the argument about this is unnecessary and it goes against the climate protection measures that are in place. That argument may be fought in other courts too. How would you respond?
Well, we're going to put in place whatever legislation and repeal whatever legislation is required. We're going to scrap net stupid zero. We're going to withdraw from the Paris Agreement, and we will ensure, and by the way, we're leaving the European Convention of Human Rights, and we're going to scrap the Human Rights Act. In due course, we'll replace it with a British Bill of Rights, but we are not going to allow eco-zealot lawyers to stop the growth of the UK economy, and we're not going to allow them, frankly, to impoverish our constituents. So, yeah, bluntly, if they want a legal battle, bring it on. We're quite good at winning, and we will beat them.
On the net zero and the scrapping of that, there is the renewables obligation, which is sort of baked in now as a cost. So am I not right when I say, even if you were to scrap it, there would still be legacy costs on oil and gas producers, which of course would affect prices to you and me in our homes.
Look, there are a raft of costs. But for example, we could dramatically reduce the EPL on the oil and gas industry. And we've told the renewables industry, don't bid in allocation round 7 or thereafter. We view that as a lie, a con, an outrageous, elongated subsidy. We will wrap up those contracts. We will rip them up. They will be null and void. We put them on notice, caveat emptor, don't do it. Likewise with the solar farms. And again, we'll take you on in the courts and we will win if required. We'll pass the appropriate legislation. The British people are sick and tired of being shafted by this outrageous lie that renewables are cheaper. If they're cheaper, just ask a simple question. Why is the strike price of AR7, first of all, it's 5 years longer, 20-year contract, and why is it about 40% higher than AR6? Funny that. So, yeah, we're going to take it on and we're going to win. And if we do that, and if we have a much greater supply of oil and gas domestically produced, we'll create higher growth and we'll start to remove all of the whatever levies we can from energy bills. We're going to look at that very, very rapidly to bring the bills down.
So if I follow the logic of what you're saying, Richard, the AR7 auction would have no bidders, would it?
Hopefully.
Because you're trying to disincentivize them from bidding.
Absolutely right. We've told them for months. I've met the energy lobby. I've met the renewable UK people. I've told them, don't blow your shareholders and your lenders' dough. Invest in gas, invest in nuclear. If you invest in these renewables, then you do it at your own peril, frankly.
We've been reflecting on the programme about the change of tack advocated by the Tony Blair Institute report, which came out recently. And I think Bill Gates seemed to be saying the same thing too, that net zero by 2030 is now not doable. Why don't we take things a little easier, try and reduce the cost of energy for consumers, and head for 2050 at a more sensible pace? Does that make sense to you?
You shouldn't put any date on it at all. Look, climate change is real, has been for millions of years, always will be for millions of years. The arrogance amongst the eco-zealots who think that they can stop the power of the sun and stop the power of volcanoes, that are the two primary determinants of climate change, is truly shocking. And I can tell you my constituents are raging furious at the cost of their bills, that the idea that 100 square miles of Lincolnshire should be covered with solar panels completely surrounding whole villages, the idea that hundreds of pylons should blight my constituency is nothing short of a scandalous outrage. I've told National Grid, bury the cables or we will force you to bury them at your shareholders' expense. So people need to know we are deadly serious about this. Net zero is the wrong thing at the wrong price in the wrong time frame, and we're going to stop it. We are rapidly changing the course of the debate and encouraging investors and shareholders, invest in oil, invest in gas. That's the future.
Local power generation, though, can and does work in parts of the country. A field or two of solar panels in Lincolnshire could power a whole town. That is the case, isn't it?
No, sorry. It's an outrageous misuse of productive agricultural farmland that should be used for food security. And solar power is weak, it's inefficient. What happens when the sun doesn't shine and the wind doesn't blow?
There's still some power generated by solar panels, isn't there? It's not as much as when the sun's out, but there is a little.
If you want to stick them on roofs, fine, but don't stick them on fields. We're going to stop it. And by the way, we're being lied to about the safety of the battery energy storage systems alongside them. When they catch fire, it's pretty ugly. The fire brigade cannot put them out. So we're just not going to tolerate this stuff. Put them on roofs. That's fine. And I'd much rather they weren't made in China.
Well, yeah, but they are made in China at the moment. And the Chinese are investing in this, aren't they? And I noticed that Pakistan...
That's impoverishing us. If we buy wind turbines and solar panels from China that they make using coal-fired power stations, they're making us economically vulnerable. They're making a fortune, and we're increasing our electricity prices, making our industry uncompetitive. Everyone's going bust or laying off jobs. We are impoverishing ourselves, and it's got to stop.
I was just wondering, though, the argument used to be, why do we try and get to net zero in little old UK, a relatively small energy consumer, when China and India and other countries are still racing ahead with coal-fired energy generation? But there are stories coming out of China. They've invested more solar, I think, in the last 12 months than ever before. Pakistan have installed solar. California, most of its power is generated by solar most days. Are we not at risk of becoming behind the curve in this?
I don't want to buy Chinese solar panels. I don't want to be beholden to them. This is just an outrage. And I repeat the point. It might be efficient where the sun always shines and is reliable. But guess what? It doesn't always shine in the United Kingdom. And some days in the southeast of England, we are importing 50% of our electricity from continental Europe. And let me just remind everybody, before there was any renewable power, about 17 years ago, no one was talking about the price of electricity. No one was talking about rationing or possible blackouts. The growth in electricity prices in the UK is directly linked to the growth in renewable energy generating capacity because of the billions and billions of pounds of subsidies paid primarily to overseas investors.
Can I just mention fracking?
Yes, please.
It's gone off the boil a bit in terms of this particular government, and the Tories, when they were last in power, seemed to go a bit cool on the idea. You're not. You quite like it, don't you?
Well, let's be clear. We're talking about shale gas, which is the energy treasure under our feet. There's a decade plus worth in Lincolnshire alone. And fracking is just one technique of extracting shale gas. There are other techniques. The technology evolves all the time. But why is it that America's got gas prices a third of ours? The answer? Shale gas. The answer? Because they frack, they extract it. There's about 20 million people that live within a mile of a shale gas well. They barely know they're there. They're tiny. They're safe. And that's the reason why the American economy is growing fast. It's powering ahead. They get richer. We get poorer. It's a catastrophe. We should be using all our energy treasure. We should be using the technology as it evolves. And it's a great opportunity. We should go for it. I tell you what, when I talk to people in Lincolnshire, they're very proud of the idea. Lincolnshire gas for Lincolnshire jobs and Lincolnshire growth.
You haven't got perfect unanimity within your party, though, in the wider sense. As few councillors who work under the Reform banner don't approve this. They say they will oppose the idea. You've got an argument to win, perhaps.
No, that's the joy of democracy. But again, very often people have been given misinformation, haven't looked at all of the facts, and have been sort of scared by nonsense, fear-mongering by the vested interests, the zealots. And look, there's an education process. We can have independently monitored and supervised wells for a year or two to put at rest those who are concerned about it. But I just repeat the very simple point. Look around the world. Anybody with energy treasure of oil and gas under their feet that is growing, guess what? They're extracting it and they're using it.
London has to be the hub, doesn't it? What with the Brent oil price and everything of oil trading. That's come up from when oil was first a commodity, and we've developed a certain amount of expertise. And here at Onyx, they're derivatives traders, one of the leading ones in the world. Is that an expertise we should let go lightly?
Of course not. We shouldn't let any expertise go. We know that we're good at this stuff. We've been good at it for whatever it is, 50 plus years now. And every time we import oil and gas from overseas, it's very simple. We are exporting our money and our jobs. And so no, let's use that expertise. I'm concerned about over-regulation in the City of London, in our finance markets. Are we talking about that in the weeks ahead as well?
All right, one more thought for us in terms of the gas import dependency, which is expected to rise even more by the year 2030. 85% we will need to import the gas we need by 2040, according to some stats I'm looking at here. You say that the North Sea oil reserves and gas reserves, how much additional domestic gas do you think this would produce annually? Do you think it would meet our needs, Or is there not the argument that we will have to move to a greater proportion of renewables by then?
Well, one thing's for sure. If you don't try, you've got no chance. It's actually grossly negligent of Parliament not to even try. And that's the way that this deeply socialist Labour government is going. I say, let's look for as much as we can. I say we should encourage people to explore, to produce, to extract, and you can have long-term purchase contracts domestically, bring the price down. And yeah, you may or may not have to import some, but we can produce a lot ourselves. That's good for jobs. It's good for communities, families, regions. It's good for the country. We know it works because guess what? In the 80s and 90s, we were growing at 2.5% to 3.5% almost every single year. Now, folks, break out the champagne if we get to about 1%. I don't call that growth. I call that barely a round of drinks.
So you're not going to be putting in any kind of renewable fuel in your home or homes anytime soon, Richard? You're just not a convert to that?
Look, as I say, solar panels on roofs, for example, I've put some, not Chinese ones, by the way, I've put some on the roofs of my industrial units. You sell the electricity generated when the sun shines to the occupier underneath. That helps everybody.
Where did you get them from then, if they weren't Chinese, may I ask?
I've got them from elsewhere in the world. I've had to pay a slight premium for it.
Well, go tell us where. If it's not China, where? Who makes them?
There's places, for example, in Canada and elsewhere. And so I just think that we have to be very, very careful about becoming over-dependent on China, that is basically trying to economically strangle Western nations that are stupid enough to fall for this net stupid zero. And guess what China will do? They'll then say, doesn't look as though it's worked very well for Western nations that have gone semi-bust. Maybe we'll delay our targets. I'm just alerting people to the huge dangers and the huge opportunities if we use our energy treasure. Oil and gas, it's brilliant.
Hi everyone. Today I'm joined with Martha Dowding, who is a research analyst and Flux Insight team. And with the Flux News launch, we're going to be doing more and more on weather. So we thought we'd start with an introductory discussion around weather patterns and which specific weather events obviously impact the trading market in particular, some of the historical moves, and then thinking going forward and kind of reviewing the year as well. So Martha, you want to take us away?
Yeah, of course. I think we're going to keep it evergreen today, but just for context, we're coming to the end of the 2025 hurricane season now. And this is a graph of all of the hurricanes that has been in the Atlantic this season. And as you can see, it's been a pretty lucky time to be living in the East Coast of America, bad time to be a fish, and lots of these kind of fish storms. So we have seen lots of the usual hedging from players kind of amount to nothing. So that's being taken off now. So I thought I'd have a look at some of the usual impacts on crude and a couple of products for some specific hurricanes.
It's just butting in straight away, just because gasoline has had a big move, particularly in Europe. And I guess there's a lot of things going on there, but you would expect if you looked at it on a graph and during the time, a hurricane must have kicked off.
Yeah.
Not at all, right? So it was a very
people have such trust in forecasts because of the way that weather works that people start hedging ahead of the hurricane. So it's not like it happens, then all of a sudden there is panic buying, although we have seen that quite a lot. So we do see kind of the build up to it, and especially the later in the season it gets, the more it's kind of like, oh, we're finally going to get a hurricane. We're finally going to get a hurricane. We did kind of see spurs of buying because of that.
Okay. But you have to say kind of a bit uninteresting from a seasonal basis, no?
It's interesting because,
market perspective. Okay, so leading in. So
this is just purely why this is just for me to talk about the weather for a minute. So there was the high pressure center around Bermuda that was a bit lower this year. So as you can see, that means that the path that the hurricane would take from the coast of Africa is going to be more to the east and a bit more north. And there was also a kind of a front of low pressure over the east coast, which kind of disrupted that as well. So that's why we saw this, it was just an incredibly lucky season, I'm sure. Incredibly lucky season.
Okay. So I think we have to say as well, like newcomers, whatever, but we know with hurricanes, it's about what the hurricane impact actually is. So it's always a bit confusing. Is it going to hit infrastructure like a refinery, and then that's kind of bearish crude because they can't buy the crude, and it's bullish products because they can't make the product? Or is it taking off storage, or is it going to be demand destruction? That's what's always confused me a hell of a lot. Like, okay, there's a hurricane, but we don't actually know what that really means. So traders are always looking, aren't they, for the path and what.
Yeah, that's exactly what the most important thing is. And that's actually a great lead into the first hurricane we're going to talk about, which is Hurricane Ida. As you can see here, in 2021, that hit exactly where Mars crude in the States gets pulled out of the Gulf of Mexico, Gulf of America. And you can see there's another graph here showing exactly all those offshore drilling had to be evacuated, it got shut in, and as well as seeing the usual effect on the WTI spread, which is kind of a softening of the spreads, as you can see. So usually in hurricanes generally, you do see a softening of the TI spreads because, as we often talk about, WTI has a tendency to kind of pool in place that when they can't export as much, and if there's any damage to kind of infrastructure refineries, you can see a few examples here and also a little chart of why the spreads do suffer. So as well as seeing that in 2021 with Ida, the impact that the hurricane had on the Mars grade specifically was really clear.
Yeah, very bullish. Which, it obviously makes sense. You can't get access to the Mars crude. It's going to go big. But again, it can be confusing because obviously the weakness of WTI is because it can't export. So you have to get that nuance right, and it's not like a repeatable trade. Just nothing else to say. It's why I don't think people really like trading it, because it's so randomized. But I guess what you can do when the hurricane is forming and when it's becoming closer and closer to impact inland, you can at least look for the momentum trades, right? You can look for what's starting to react and what people are starting to gauge. And I mean, that's a half decent trend following trade. Like you can see it here. I mean, it's rallied 250 all the way to flat. So that's per barrel. So it's quite a lot of entry level to get in and ride that up as that was moving. That's the only thing I can really say there.
Yeah, this was the largest, clearest impact on this specific differential that I saw, but you did see it kind of inching up when you see the path leading into the Gulf of Mexico like that. I think it's quite a niche trade, but it's interesting.
It's a niche trade, but because it's a niche trade, it's very specifically what would impact the market from the Mars terminal going down, obviously the Mars differential. So that's quite nice in a way. Whereas WTI spreads, of course, you've got a lot to contend with. And if it's not a minor hurricane, but it's something that will cause days of damage rather than weeks and months, like, and obviously some of the more extreme scenarios, then you're a bit like, well, you know, am I going to sell WTI spreads maybe on the backdrop of a very strong Cushing market, and there might be a big draw in the EIAs? So again, maybe another thing that probably comes up in the history is, if you can find those niche expressions that are kind of binary, those are the ones to stick to, but it's all about execution, isn't it? So.
Yeah, and I think with the crude differentials in particular, they kind of get up and running a bit faster than getting a refinery up and running as well. Right. So I think that may also lead people to be a bit cautious down to trades like this. Okay,
so Ida hit through Gulf America or whatever, so, and hit the offshore platform. I remember it myself, 21. It's all, you all hear the whole, right, they're exporting, they're getting all the people off the Mars platform, evacuation, and that was the clearest thing. But it did reach inland, did it?
Yeah, of course. So this is the path here. We saw it kind of move over Louisiana.
So right in the Gulf Coast, which is where all the major refineries are.
Yeah, so there was refinery issues too. So there was 2 million barrels a day of capacity taken online with some big names there. We've got the Marathon, Garyville, Motiva, Valero. So like these big names you hear a lot in gasoline as well, which we'll get to in a second. But so you can see 60% of the US Gulf Coast production was shut, with 1.7 million offshore crude halted. Yeah, and again, so it is quite niche, the Mars grade again. But the thing is that the US is very sensitive. The US crude market is very sensitive to the sour grades that they need to blend in, right? So we saw that with the tariffs this year. You block off Canada from exporting their oil sands down into Cushing, and it really screws up the refineries on the East Coast, right? That's what they rely on. And then it actually was very bullish gasoline. Like, there's always knock-on effects. So Mars might seem niche, but actually, you know, it's got to be replaced some way for the Gulf Coast refiners. And who knows, it might have caused like a few knock-on effects. Maybe you don't have that right here, but it'd be interesting to look into with those heavier grades.
So what about the product side? Because it did hit a refinery, as you said, or it did at least take capacity offline. So it's all about the production there, of which obviously the US export products, but they also export internally, domestically, right, up to New York, which is a big deal.
Yeah, so I think like looking at the New York Harbor, US Gulf Coast differentials for gasoline, that's interesting, but we don't really trade those so much. So I did try and keep it looking at the ARB between the US and Europe. So you can see here the graph of when the hurricane hit. We can see that jump in RBOB, which is this green line. It's kind of, I think because it's in September, it's kind of, we're expecting a hurricane to come. And I think there'd just been one a little earlier in the season, a bit less strong. There wasn't the kind of significant jump in prices that I was expecting, but we did see this kind of trend down in the ARB, the gasoline ARB, after the other gasoline the other gasoline focused like little study I did as well. So that must be something that kind of to expect, because that's a fairly significant drop.
Yeah, and again, it's the backdrop of positioning as well. Like I actually put that in my book. It was one of those ones where, you know, you expect refineries offline, bullish gasoline, but if everyone's been expecting it, that is the thing with hurricanes. You do get quite early warnings. You know, it's weeks you can be
you can obsess over it.
Yeah. So I think by the time it actually hits and there's the expectation that it's going to get hit, or a high probability it's going to get hit, then you're probably going to have RBOB positioning in there already. So, and if it hasn't really moved up towards that, you're probably getting a lot of sell side resistance. Is that because people are taking profit on the rally? Is that because people don't believe it? Whatever. But it's a very difficult one to be early to, I would say. But the knock-on effects, a lot of the confirmation, you again can maybe get from the more niche trade. So the ARB, again, that's probably a more higher percentage trade, because if it really is cutting off some restricted gasoline, it's probably not a huge deal for the global pool of gasoline, but relative on an export basis, of course, it's going to cause disruption. So a high percentage trade will always be, in my opinion, like the ARB going up, right? A relative value trade, or down, depending on what we're looking at here. But I think, I don't know, that's kind of my anecdotal point of view on that.
I think people point to it being priced in very easily, and it's the kind of thing with the same thing we see every week with the stats, when people are like, should have gone up and should have gone down, when it turns into kind of a liquidity trap, and it goes up to such a level that, this is great to hedge out, and then you see it come straight back down.
Or, you know, the thing about sell the rumor by the fact type psychology, you know, you see it a lot with the EIA stats. You've got Genscape coming out on Monday who kind of preempt what the EIA is going to say quite accurately with their satellites and whatever. you see the market react or position for a stock draw or whatever, and if it was a hurricane, it's a hurricane. And then when you actually get confirmation in the news, they use that as a liquidity event.
Yeah.
So again, it's difficult in this kind of game because you're always playing that lead lag between the people who have the information right on hand, or have literally been speaking to someone being like, I'm on the Mars platform, I'm getting taken off. Do you have that kind of instant access to that information? Anyway, let's move on because this is that was quite detailed.
Yeah, and this is just more as to why there was not a huge difference in price, why there was kind of cushioned. You can see stocks were decent. There was no huge power outages, and I think Colonial was off a little, but it wasn't as badly as we'd seen other times. Although that can also be quite unpredictable, the effect that has on gasoline too.
So do we have a hurricane which really caused shockwaves in the market?
Well, yes, we do. This is the Hurricane Harvey from 2017. This one, as you can see, inland, really significant, not a huge path, but pretty powerful. This took more than double the refining capacity online. About 25% of the total US refining capacity was taken online by this.
Wow. Okay, so there, I'm obviously assume, I can't really remember it because 2017 I was definitely trading crude, but I mean, Omar must have been trading gasoline at that point. So what did happen actually? I can't remember.
So let me just check the dates. Yeah, so this is late August. This has a much clearer rally in the both EBOB and RBOB cracks into the end of August here. And then again, it's got sold into. Whereas this had less of an impact on the ARB, I think because I'm not too sure why, but I think it did still see that drop afterwards, like I said previously. But I think for this one specifically, with such a huge amount of refineries down and the amount of time it takes for refineries to get back on track, making gasoline of good quality, we did see this really significant rally.
Well, it looks like we had quite a bit of volatility on the ARB as well. So that looks like a choppy one. Again, given its extremity, I imagine there was a lot of aggressive positioning. So yeah, the bigger the hurricane, the bigger the event, the bigger the expectation and positioning and volatility. So that makes it even more tricky, which again, like, you know, I would have said high percentage trade is what I just said before, but it looks like the ARB was as choppy as anything else. So probably quite a tricky one. Be interesting to hear from somebody who's actually trading that, what they think, but I don't remember. So yeah.
Sorry. Yeah, so that's for gasoline. And then for LPG, it's similar with the import-export situation of the States, of it being easy to pull, LST in particular. So this is looking at Harvey again and Laura. So with Laura, the problem with so many of these things is to isolate a cause and effect. There's obviously a million other things happening at the time. So with LST, the LST FEI differential, which is what we usually look at to measure the strength. You can see here, this is taking some of our Flux data and historically. So Hurricane Laura was in 2010, so that's the yellow line. You can see that's seasonal highs, that's all-time highs for the LST FEI contract. But we can say that...
Sorry, 2010, what happened, sorry?
2020, it got sold down to from there, which you can say was because of hurricanes. You can also say it's because the Panama Canal was very congested. And there was just a whole series of reasons to start selling this, and also they're extremely high prices. But that was a pretty significant drop from Hurricane Laura added to that as well.
Got it, okay.
And Hurricane Harvey, which we just mentioned, that's just a similar thing. We see fractionators down on the coast, which means that you can't export gas specifically in the right, C3, C4 amounts. So we can see pooling of propane in the States as well in the LST, and we can see pressure on the ARB from that.
Okay.
So yeah, you can see that here in late August of 2017.
This is going back to Harvey, yeah?
Yeah, this is the 2017 Hurricane
Harvey.
So
we were pretty damn high on the ARB actually, or at least if you compare it to these days, but it came off a cliff, right?
Yeah, huge drop there, yeah.
So in terms of higher percentage trades, then that's also a pretty decent one. I much prefer these export differentials in weather events like this, because it's just, it's temporary, right? It's never going to be like, well, no, I shouldn't say that. It could have huge knock-on effects, and they have been in the past, but generally speaking, you get these flash events, these weather events that can quite consistently, and there's going to be disruption, but you want to isolate exactly where the disruption is, get that highest percentage trade as possible, like we said with the Mars TI. So you've got to look at these things. And actually LST FEI, we got big in propane kind of like 2018, 2019. So this is just before that. This is the kind of thing you would be expecting to have a lot of positioning on, given its kind of predictability. So that was interesting. So that's hurricanes. That's kind of summarized hurricanes. And just, I guess, just to finish off the 2025 part, you do get these indications early on in the year that this is going to be a year for hurricanes and that kind of thing. Wasn't that said this year? Yeah, and that's because of the La Nina.
Sea surface temperature, the second highest it's ever been, with the highest last year. I think we're the one or two of the highest at different points of the time. But it just shows that we're all kind of at the mercy of more than one predictable thing. We can see that the surface temperatures are so high, but without the correct path and without the pressure differentials being, in your favor, you're not definitely going to get a hurricane. And I think we're getting better.
If you do, is there going to be a hurricane?
Yeah, so we had really strong hurricanes, but they just were at sea.
Okay, so that was hurricanes. Moving on to, I guess, something quite important these days is heat.
Yeah, so we've been seeing a trend recently of extreme heat in the summer. I think focusing initially on Europe, I think last year was especially hot in 2024. And then prior to that, I think the most significant heat wave was the year before in 2023. I think we got off fairly lightly this year in 2025, but it's still really important to have a look at the kind of effect on the European infrastructure and products, power and gas and electricity, because not only is this part of the market, but this is something that directly impacts the consumer and everyone watching this. So 2023, looking here, because this was especially hot, we can see the Med refineries were forced to cut up to like a third of their production over the summer. So Macquarie yeah, thank you. Sorry. Said that heat-related disruption reached about 1 million barrels a day, which is about 10% over the whole year. So this is really, really impactful numbers, and it impacts different refineries in different ways because of the different units, ability to kind of handle the heat. I think when you look at heat and you look at hot weather, the most sensitive would be the FCC, the fluid catalytic crackers, which make gasoline and other, smaller hydrocarbons, and also hydrocrackers, which also produce gasoline. So it's really important to kind of have a look at how these are going to be handling it. Refineries in Europe aren't built to handle the temperatures that, say, refineries in the Middle East are. But even now, I've heard reports that like this year, during the 2024 summer, 2025 summer, they were going to have to cut some of the run productions from in the Middle East, and their whole refinery system is built at a different pressure so that it can handle temperatures up to like 55 degrees, but temperatures are passing that now.
Yeah. I think absolutely topical. I actually remember now, like 2023 was such a basically market move in the products because of refinery fires, refinery overheating, and there being issues in the US as well, right? US and Europe.
Oh, definitely, yeah.
And so given 2023 was quite a difficult year in terms of predicting outright price towards the end, I think it was starting to get a bit more uncertain. I remember coming into 2024, there was an incredible amount of like Q3 buying, basically predicting another heat wave disruption. That was like the leading narrative. And I guess the global warming narrative that you hear all the time, and because it had happened in 2023, people were getting really overhyped for that really early doors. And you just got a massively oversaturated product market in 2024 for the summer, way too early. I remember Bloomberg reporting about record open interest Q1 for this type for these contracts for products. And it didn't materialize. And when it doesn't materialize, everyone's expecting it. And obviously, it's a bit of a bloodbath, or makes the market difficult, if you like. But it is funny like that. Like, even it's almost like anything we do, if things are so expected, they tend not to happen, right? but having said that, the other side of trader psychology is if it doesn't happen, you think, okay, it won't happen, but then it rears its head again. And there's all these things you always forget. Like, if next year there's hurricanes impact inland, I mean, recency bias, I haven't really, it's been a while since there's been a big impact. So if something happens now, I think there will be a lot of people on the back foot, and it will be a lot of volatility. And I think the same to be said about heat, you could say.
Yeah, it's interesting because looking at kind of the chemical engineering process, it's going to be less efficient. There's going to be optimization issues because the FCCs aren't able to cool themselves as they should because ambient temperatures are higher. That doesn't mean that there's going to be fires. That doesn't mean that there's going to be huge issues, but it just makes it more likely. Same with the hurricanes. Nothing is an inevitability. And I think when people get overconfident, that is how, that happens, how you said.
And this year, there was, as you say, we got off quite lightly in Europe, but there were pockets of this extreme heat. And in particular, the one that stands out from memory was in France, the nuclear power stations, like the water around it, like the river, I guess, or the surrounding water got so hot it couldn't cool down the nuclear reactor. So it really caused some volatility, at least in the electricity markets, power markets. But as you say, like the inclination there is like you have your energy stack in Europe, right? You have nuclear power, you have coal, you have oil at really kind of extreme. But either way, when something goes out, it is an outage nonetheless, and you have to put pressure on other substitutable commodities. So it's always something to be super aware of, even if you're an oil trader and saying, what do I care about nuclear?
Yeah.
It does have an impact, right? Something to be aware of. And as you said, going forward, more and more, this is likely to happen. So.
Yeah, I remember you saying on the podcast last year that people say nuclear is this kind of like magic response to kind of global warming and everything, and people using coal again. But because of the state the world is already in, the cooling facilities aren't really possible, and there are such stringent regulations in Europe that you can't be discharging water at a certain temperature. In France especially, it's really quite low. So I think if we're seeing nuclear build up more, we might have to see a bit of a drop in those regulations.
Interesting.
So looking to the Middle East, we saw a kind of different demand in this summer and also last summer kind of rear its head. We saw a lot more fuel oil demand, so high sulfur fuel oil.
It's air conditioning story, right? This is now a big theme for the market as well.
And it was definitely like one of those narratives picked up by the media, and we saw bunker demand increase as well. But there was this aircon story that people really latched onto.
Yeah.
So we can see, looking at the graph here, the 2025 seasonal highs, all-time highs in the 3.5 barge crack, which is the Euro high sulfur crack, and it's especially obvious when you look at the east-west. So the difference between the 380 in Singapore and the 3.5 barge crack in Europe, that got to new seasonal lows as well at the end of July because of this like really high demand coming from the Middle East.
Yeah, and just conversely to what we've been saying about hurricanes and the unpredictability, even of heat in Europe, I think the air conditioning story it's a lot more structural, if you like. It is every year. And I think it's almost just something that the countries like Saudi Arabia are very keen to do, right? It just makes sense for them to be exporting less fuel use whilst it's obviously cheaper than crude, and they can play around with the exports and what they're doing. That draw on fuel oil is going to be, I think, something quite staple in the market, and therefore probably quite likely to be priced in quite regularly, a bit like 2024, like I was saying there. So, but still a good one to point out. But I guess if you were trading this, the stuff in Europe, you're probably more looking at electricity prices and gas prices, a bit harder maybe to trade that on an oil basis.
Yeah.
Unless there's a refinery fire, particularly from the US or that kind of stuff, then the obvious happens. But yeah, as I say, the more structural one to look at is probably fuel oil then.
Yeah.
In the summer. Okay, so that was the hot. What about the cold?
So looking at the cold, we're going back to 2021, which was a rough year. So we're looking in the States at, we had this storm Ida, which we've seen the phrase actually last year as well. I don't know if that's just when I became interested in weather, but this kind of polar vortex, this cold air being pushed down from, the Arctic down into the United States. So, through Canada. Just basically a quick description is that you have the polar vortex kind of spinning around the North Pole, and then you've got the jet stream below that, still like 5 miles, I think, above the Earth. But when the polar vortex weakens, the jet stream weakens, and that cold air can kind of pass down. And this was especially bad in 2021 during the Texas freeze, Ida, because there was this area of low pressure over the States as well, which is spinning anti-clockwise. The polar vortex spins clockwise, and that meant that
carnage happened.
Yeah, carnage
So this
happened.
this is what year?
2021.
Okay, 2021, because the Texas freeze that I thought maybe that was 2021 as well, but the one that we had in 2023 and into 2024, I think we at Onyx probably know all too well, because that was an enormous impact on propane, actually, right? It got so cold that you had the wells being frozen. And that was pretty unexpected. We got crude rally. We got the WTI kind of differentials going bid around some of the Texas areas. They're all kind of predictable on that front. But I think the propane one, we thought there was so much supply at the time. It was just not as expected to be so bullish. And I think we'd already had quite a big ARB rally. We'd already had quite decent spread rallies. So for it to really go on from there as much as it did, that was a blowout performance really for the propane markets and caught people by surprise. So again, it's a repeated one. When you see the Texas freeze, there are well, you can tell me, there's probably other trades, but for me, it would be straight to propane now. I'm always thinking.
Yeah, straight to propane. And actually, we'll come back to this a bit later when we talk about La Nina, which we're talking about with the trader kind of chat the other day, which is another really interesting way to kind of look at the intra-United States contracts, the regional contracts as well. But yeah, this is just an example of the electricity at the time, ERCOT, which is in charge of the grid for Texas, because it's not connected to the rest of the country, I don't think. They basically from 2021, in 2023 and 2024, there were far less severe power outages, which because after 2021 they were in such bad trouble that they had to weatherize, is what they called, the whole the grid. So that's meant that there was a far less significant impact on power prices.
But propane there was.
Yeah, that's different.
On retrospect, yeah, it was potentially, of course, the cold, right? Propane used for heating in homes. But I think the wells freezing, at least from memory, was the unexpected one. How can it be that cold that literally you can't even produce this stuff anymore? That's pretty nuts.
Yeah, that's
Yeah.
and they're just not used to it. But this actually leads pretty nicely on to talking about La Nina, which is happening this winter. So you can see this is to do with the ESNO and like complicated weather things. But it's basically in each season, you're either going to get La Nina or El Nino or nothing. It's neutral. Right now we're in La Nina, which has been confirmed for winter. So looking at the United States.
Sorry, what's the difference? So La Nina is basically this, as you've got this chart here.
Yeah, it's to do with the ESNO, whether it's positive or negative around the equator. There's this.
What does it literally mean? You get a cold.
Yeah, so this is the typical weather pattern of La Nina. Generally, you're going to get a colder. Like we just said with the polar vortex, the jet stream is less consistent. And as it's more variable, we expect colder air to be pushed down from the Arctic down lower into the states, where it's a bit warmer at the southern states. So this is kind of the expected pattern. And because of that, there's this differential in the states called the North-South differential between Conway and Mont Belvieu LST, which I think could be a really interesting thing to keep an eye on,
super
especially
niche, though, hard to trace.
Very niche, but
yeah, no, look, you can get some stuff off, and yeah, that is interesting. Sorry, so again, La Nina versus El Nino. One's basically La Nina's creating this pattern, and what's the difference with El Nino?
That creates just a completely different pattern. I don't have a graph for that right here.
But we're sticking to La Nina then. Yeah, it's cold where? Sorry,
cold coming in from the north to down.
Yeah,
and then it should be, and also
so basically you're bullish to north-south.
Yeah.
Bullish to north because it's obviously colder.
And also there will be an impact. Propane is used a lot for crop drying.
Yeah.
So the crops will be wetter and colder and they'll need more propane to dry them around the Corn Belt, around the Midwest, which is where it will be colder and wetter.
Interesting. Okay, and more domestic demand, I guess. And so just generally quite bullish, but particularly the north. Okay.
Yeah, sorry, that's very niche.
Cool. Yeah, no, that's good though. I mean, again, this is the thing. So like we keep saying on all these different ones, if you want to know what's the real impact on the market, I think you are looking at the niche differentials. So you look, okay, and I remember doing it myself. So what's really going on here? We were like, okay, if there's real wells being impacted, like where is the main concentration of propane being produced? So it's like, we're going to look at the Conway contract, not the LST. We're going to look, and I know it's a niche differential to LST, but we want to know what's going on there. So that will give us an indication, is this real physically or not? Or is this just, just a bit of hype and just a bit of positioning and speculating? And that's a really important thing to do. So it's just another reminder. It might seem super niche, but you hear La Nina, you look at the propane markets, look at the north-south differential to get your indication that it's real. That's very fair, I think.
Yeah, and of course scale matters. So if it's colder across the whole country, then there should be more demand for the whole propane market in the States. But
fair.
So lastly, just looking at cold weather in Europe, this is the graph of the LNG stocks year on year. As we can see, we're not looking super high right now. Of course, we're still,
Yeah, this is EU, right?
This is the
There's
EU.
all this talk this year is like, are we going to mandate the 80% storage that we have done before? Market was getting quite excited about that in that market because, it's basically essentially front run that, right? They front run the storage, but it got relaxed a bit in some I think some EU states, but whatever. The point is that was a factor. But I think what's super interesting about the storage and about the LNG story is that because LNG is replacing obviously a lot of Russian, when we had sanctions just yesterday, right, they're able to have these renewed sanctions because they've stabilized their supply, particularly for LNG from Qatar, from the US. so they can then squeeze the Russian supply again. So it might not seem like it impacts oil, but as in what's happened is because Europe are in a position where they're happy with their LNG storage, because it's cold, but it's not that cold, no one's too worried. It probably had a part to play in how they were able to go after these big oil and gas sanctions in Russia. You should never not look at it because it's political, right? Markets are so political these days. It's incredibly important to know what's happening in these core markets, even if they're not directly in oil, for this exact type reason. That would be my addition. But generally speaking, it's cold.
Yeah, I think we're expecting a colder winter because of La Nina. Okay. But we're looking at decent levels. Like, it's not like stocks are on the floor, like 80 something.
Yeah.
And we've seen there are more LNG kind of facilities to get all of the LNG that America's trying to ship us, being built year on year, and consumption's trending down year on year. But we saw a spike the other day of just some stats coming out. They're a bit bullish and prices, jumped up. We're in a really reactive market, I think. Right. I think TTF is really, really reactive.
Okay, understood. Well, Martha, that was great. Thank you all for the summary, and thank you for the whole summary. But I think just to conclude a kind of major themes there, I'm just going to repeat it because it's one of those things that you want to say, okay, I want to buy or sell something liquid when one of these things happens. Whether it's a very evidently a niche thing, even hurricanes, heat, cold, whatever. It's always but where, what's it specifically going to impact? And again, I would always reiterate. If it's a physical impact, you got to look at the physical market. You got to look at the differentials that are going to affect the physical market. So that would be the export differentials, like the ARB gasoline from US to Europe, or the other way around, Europe to US. We've got those North-South Conway. We've got all those kind of differentials like the Mars WTI for exporting. That will give you the confirmation on the physical side. Then obviously when you're trading the derivatives, you've got to weigh up other things like you always do, positioning and flow and all the rest of it. But at least you should know from these indications whether the story actually is real or if it's just a rumor. And I think that's kind of like the main message. And then trading off the back of it, I mean, I don't think we've been super clear how to make money out of that. That was not really the point of this, but maybe that's something we can do in the future. But generally speaking, there are key contracts. The air conditioning, it is about the fuel oil market mainly. Hurricanes, it is a lot about gasoline and maybe Mars and WTI to some extent. The cold, like you said, in Europe, it's really more about electricity and gas.
Yeah, gas,
but propane in the US. And I guess it's just having that up as an event trade or something you're looking at. In the case of, have up your list, hurricanes or whatever, these are the key contracts I've got to look at. And that will repeat itself all year round, every year. So cool. That was a great introduction. You'll be doing some weather shows going forwards. And obviously, whenever anything happens that is significant to the oil market from a weather perspective, Martha will be there. So thanks for listening. I hope that was interesting, and see you again soon.
Hello and welcome to the European Market on Close. My name is Will from The Officials. Today the window is again pretty quiet. The market still just feels quite uncertain. It was just Mercuria offering a Midland for the 19th to the 23rd of November. After initially starting at dated plus $1.80, they offered down a few times, all the way down to $1.30, and that was setting the diff much weaker. So if we pull up our physical differential chart, you can see we've sold off all the way to almost flat. That's down about 10 cents on the day. I mean, the question that's really kind of gripping markets at the moment is what's going to happen with sanctions? Are sanctions really going to reroute flows? I mean, India's been buying PG grades in order to rotate out of Russian crude, but some sources are saying that those have already been resold. And Hungary's MOL say 80% of its crude will come from non-Russian sources. That's pretty bold given recent profits were so reliant on cheap Russian barrels. And if we look at crude structures, they're not showing panic for unsanctioned supply. If we look at the prompt Brent spread here, it bounced from 21 cents yesterday to nearly 40 cents this morning, but has slipped back to just below 27 cents at the time of recording. And on a flat price basis, I mean, Brent remains trading in a pretty tight range and holding above the $63 psychological support. Another big factor that markets have been focused on has been refinery maintenance, and it's still rippling through the crude complex. Yesterday, we noted Dangote's RFCC went down, and today the CDU followed. So while crude stays soft, product cracks are ripping, especially gasoline and heating oil. If we take a look at the refinery margin, Euro refining margins are telling the same story. That's up from $3 last September to over $12 today. But that rally is starting to cool a little bit. And we had, briefly at least, our first red candle since Monday. That has since gone green again. But look at the size of that upper wick. It really does feel like a tentative market at the moment as traders are trying to digest information. So stay tuned for all the latest updates on our Twitter. Thank you for watching and have a nice weekend.
you.